Good evening, students. Welcome to the SL1 pre-scene session. So I'm going to cover the financial reporting aspect of this pre-scene analysis because Indunil has already conducted the pre-scene session covering the risk governance and ethics part, right? Okay, first of all, let me thank CS Sri Lanka for organizing this session for the benefit of students who are sitting for June 2024 examination for the subject SL1. Right, so introducing the session and setting up the ground rules. The first thing what I want to tell you is actually I have prepared this presentation, so I'm not going to go through the pre-scene because you all have done that by now several times, so that I don't need to shift here and there. I'm going through the PowerPoint presentation throughout my session. So always I want you to keep the mics muted as well as your cameras to be switched off during the session. And also, if you have any doubts, what you can do is you can use the chat box to ask the question. I might not answer immediately, right? Because there's a flow in the session. Sometimes the question that you raise, I would, cover up that particular area in a subsequent slide. So because of that, I might not answer immediately, but before ending of the session, I will answer to your questions, right? And the other thing is, I'm not 100% well today. So in case if necessary, I might give you short breaks. So please bear with me on that aspect as well. Right, with that note, let me now start the pre-scene analysis. Right, so if you look at the content of this presentation, there are 4 areas which are covered in this presentation about the company, right? Then in terms of the financial reporting, I'm going to look at what are the possible areas of the accounting standards, consolidation, and analysis and interpretation. Because if you look at last couple of exam sessions, in addition to the accounting standards, in addition to the consolidation, there were questions from analysis and interpretation. So how would investors read the financial statements, analyze the financial statements? So that I thought of covering that particular area as well, right? First of all, about the company. So these are basic information what it was given in the pre-scene. So the name of the company that we are talking about is the Quick Eat PLC. Initially, it was a private company. Thereafter, subsequently, it has become a listed company, listed in the Colombo Stock Exchange. Present name, current name is Quick Eat PLC, QEP. Then, what is the business that they are undertaking is the mobile platform to connect the fast food outlets, consumers, and couriers. There are 3 parties, right? So through this mobile application, so they connect food outlets, consumers, and drivers, right? So who deliver the product. So this is actually the Sri Lanka's largest food delivery platform at the moment, as well as this was the first food delivery platform introduced in Sri Lanka, according to the information given in the pre-scene. If you look at the timeline of the company, it was established in 2012 and it was become a listed company in Colombo Stock Exchange in 2020. Share capital of the company, the value or the number of shares are 300 billion shares were issued. Value of the share capital is 6,000 million. All numbers were given in millions. Then if you look at the initial ownership of the company, initially Mark and Steve, 2 brothers, held 50% each when it comes to ownership of the company. But with the listing, you need to offer a certain amount of shares to the public. So now, if you look at the present ownership of the company, is Mark Pereira is holding 32.5%. Steve Pereira is also holding 32.5%, and the public is holding 35% of the share capital of the company. So this is the present ownership. And Quick Eats PLC, that is the main company, the parent company, also holds 100% share ownership. Or it has fully owned 2 subsidiaries, namely Quick Eats IT Private Limited. We'll look at what they do in a little while, as well as Quick Eat Riders Private Limited. So there are 2 fully owned subsidiaries which are held by the parent company, Quick Eats PLC. So these are the basic information what is important for you to understand and analyze this pre-scene in terms of the financial reporting perspective, right? Then let's straight away move to the relevant stuff in terms of the accounting standards. What are the areas which we need to be aware about the accounting standards? So one of the important accounting standard that is applicable for this particular case or the pre-scene is LKS 38 intangible asset standard. We know that there are three ways where an intangible asset can be generated within a business. So whatever the way that we acquire or generate the intangible asset, always the initial measurement of the intangible asset is at cost. But what it includes within the cost is depending on the way that we acquire the particular intangible asset. If you separately acquire, let's say this particular software or whatever the intangible asset which is there on the balance sheet is acquired by a third party. Somebody else has developed it and we acquire it. Then the acquisition cost would become the cost of the initial measure. Then let me take this one thereafter. Sometimes there can be situations where certain intangible assets, because this group now has an IT company as well, certain intangible assets have been internally generated. In that case, if the intangibles are internally generated, what you need to include within the cost is the whatever the expenditure that you incur in the development phase. We know when it comes to the internally generated intangible assets, normally you can't capitalize the internally generated intangible assets like internally generated brands, right? Internally generated trademarks, you can't capitalize. But if you have this research and development process, then the cost incurred in the development phase, what you can do is you can capitalize. So that what you need to be careful here is if you are given a question and if the particular intangible asset is internally generated, you need to clearly look at whatever the cost that you capitalized under the initial measurement should only include the cost incurred in the development phase. On the other hand, in this particular question, at the moment, the second one is not that applicable. If you acquire an intangible asset through a business combination, let's say you buy another business, that particular business has certain intangible assets. For that business, those intangible assets might have not been recognized in their books because for that particular business, for the acquiree, that is an internally generated intangible asset that is not there in the books. But for the parent company, when you are preparing the opening consolidated statement of financial position, when you have such intangible assets that are derived through the business combinations, you need to measure it at fair value, and that particular fair value would become the initial cost for the purpose of initial recognition and measurement of the intangible asset. Because in a business combination, all the identifiable assets and the liabilities of the acquired subsidiary, you need to measure it at fair value, right? So these are the rules that is applicable in terms of the initial measurement. Then I'm not going to go through the full list here. In the standard itself, it was mentioned that there are certain expenditure you can't capitalize. Okay, it was clearly mentioned these expenditures item or these items cannot be capitalized as an intangible asset in the financial statements of the company. I will take a couple of things only. What is relevant for this particular case study? This is one matter: advertising and promotional activities. So now it was mentioned in the case study, one of the risks is declining in the customer or consumer demand for the platform, right? So in that case, you would incur advertising and promotional costs. Those costs cannot be capitalized. Similarly, so this particular company hire and train drivers. So yet again, the question is the cost what you incur in terms of this training, can you capitalize within the capitalize in the balance sheet? No, you can't. Because why? In case of training, you don't have the control over people. So you train people and they will leave. So because of that, you can't capitalize that as an intangible asset on the books. On the other hand, I forgot to mention why you can't capitalize the cost what you incur in terms of the advertising and promotional activities. What is the reason? So how now with regard to advertising and promotional activities, so you can't actually separate it out. Now you might say that these advertising and promotional activities are incurred to build our brand, right? To popularize our brands on the customers. But that particular brand building cost and the business activities, you can't separate it. You can't say that, okay, this is what is I need to expense and this is what I need to capitalize. So because of that, even in terms of the cost what you incur in terms of the advertising and promotional activities also, you can't capitalize. So the rest I'm not going to go through, you can go through, right? Then move into this particular area of what is important. I told you in terms of the intangible assets, if they are internally generated, you need to clearly see that whether there's any involvement of the research and the development activities. We know research means kind of an investigation. So it's an investigation to find out new scientific knowledge and understanding. It's an experiment. You don't know whether the outcome would be a positive one or a negative one. So because of that, whatever the cost that you incur in the research phase, you can't capitalize. You need to charge that to the P&L, but the cost what you incur in terms of the development phase, that is actually now you have a formula kind of a thing. What you do is in development, what we do is you do the application part of the research findings. You have certain amount of findings in your hand. You want to convert those findings into a commercially viable product, material, device, process, right? Which you can present it to the market. So because of that, the standard clearly mentioned that if you, in this particular situation, if the company, because if you look at the balance sheet, you have a lot of huge amount of intangible assets. And one of the important aspect of this business is the delivery platform. That is also an intangible asset, right? So with regard to the internally generated intangible asset, if there are any cost incurred in the development phase, can normally be capitalized. But look at this particular diagram as well. What it says, I explained this, the cost incurred in the research phase, no question expense, research expense. But the cost incurred in the development phase, normally we say that it can be capitalized, but you need to check that whether the recognition criteria are fulfilled. There are actually 6 recognition criteria. So all these 6 recognition criteria are to be fulfilled for you to capitalize the development cost what you incur as an intangible asset. Right? We look at what these 6 criteria are in a little while. On the other hand, sometimes in the question, exam might say that it is unclear whether it is research or development. Both are happening parallelly. I can't separate it out. In that case, if it is not clear, can't help, you again need to expense the particular cost what you incur. Let me quickly look at what these 6 criteria that you need to prove, right? That you need to prove to say that I can capitalize the development cost. So I'm going a bit fast because these things you have learned, just a kind of, reminding it again to say that these areas are important in terms of the case study, right? So with regard to these 6 recognition criteria, you should have a intention to complete the development. You should have the ability to complete the development. Then you should have the resources to complete the development. If you don't have the resources, you can't complete that. Then is one of the important aspects. You need to have the technology in hand. Technical feasibility should be there for you to complete the development. And the last 2 are general recognition criteria for any asset. That is, future economic benefits are proper. Without having future economic benefits, I should not capitalize anything. Then the cost or the expenditure can be measured reliably. So whatever the expenditure that you incur, you can measure it reliably. So upon satisfaction of these 6 criteria, you can capitalize the cost incurred in the development phase. Okay, then there can be a question of this nature. Examiner might say that, so these intangible assets are internally generated. So it was not clear in the last financial year that whether the outcome of this particular work would be successful or not. So because of that, as it is not sure, we have charged those expenditure to the P&L. That was done. Then current year, it was a success, so that I need to go ahead with the development phase. What I need now is to capitalize the cost that I have charged the P&L in the previous year. Can we do that? Is it allowed in the standard? No, it's not allowed. If you expense something to the P&L in terms of an internally generated intangible asset, thinking that that is the research phase, you can't take that back to the books. That is not allowed. Similarly, you should stop capitalize it, because there's a limit of cost where you can capitalize in the development phase. So the amount of the cost that you capitalized under the development stage is over once the commercial production starts. Actually, development phase starts at the end of the research phase, and the development phase is over once the commercial production starts, right? Because once the commercial production starts, you can't capitalize the cost. Instead of that, you should start amortizing the particular intangible asset, or you should start amortizing the cost what you capitalize under the intangible asset. So this is what is explained in these two bullet points, what is appeared on this slide, right? Okay. Next area where examiner can make a question in terms of the intangible assets is about the subsequent measurement. In LKS 38, both cost model and the revaluation model is mentioned as the subsequent measurement model. You know what is cost model? Cost minus amortization minus impairment losses, if any. Revaluation model means you revalue the particular intangible asset, then the revalued amount you need to amortize over the remaining useful life minus any impairment losses. But be careful, because why? For you to use the revaluation model as the subsequent measurement model of the intangible assets, okay, all these intangible assets, it can be internally generated, it can be a purchased intangible asset, whatever, there should be an active market. But the things like, most of the intangible assets, you don't have active market, right? So these are unique in nature. So because of that, most of the times the intangible assets are to be measured, subsequently measured at cost. Unless otherwise you can't have an active market, you can't use the revaluation model. Right. So these are the important areas in terms of the intangible assets, LKS 38, that you need to be aware in terms of this particular pre-scene analysis. So I'll go to the areas of the pre-scene in a little while, right? Especially in terms of the business model, revenue recognition, what is important. But as a startup, so we looked at, first of all, the application of LKS 38 intangible assets. Now, if examiner wants you to test this particular area of intangible assets, he would definitely combine that with an impairment of asset standard as well, LKS 36. Why? Because normal rule of this impairment of asset standard is entity needs to look at whether there are any impairment indicators are available for a particular asset or a particular cash generating unit. If there are no impairment indicators, which means impairment evidences, there's no impairment. But if entity find out there are indicators of impairment, you need to go to the next phase. What is the next phase? It can be called as impairment assessment, it can be called as impairment review, or it can also be called as impairment test. So you have to do the impairment testing. In impairment testing, what you do is you compare the carrying value with the recoverable value. If recoverable value is less than the carrying value, if you can't recover at least the carrying value, you have to book an impairment loss. We know that recoverable value is the higher of value less cost to sell and value in use. Because when you have an asset, you have two ways to recover the value of the asset. What are two ways? You can immediately sell the asset and recover the value. That is the fair value less cost to sell. On the other hand, you can use the asset in the business and generate future cash flows. Then you get the value in use out of that asset. As you have the option to select either to sell now or to recover the cash flows of the asset. So because of that, you take the recoverable value as the higher of value less cost to sell and value in use. And where you find that if the recoverable value is less than the carrying value, you need to book the impairment loss. That is the normal rule. The point I wanted to highlight is you do this impairment testing only if indicators of impairment is available. If you don't have any impairment indicators, you don't do the impairment testing. That is the general rule. But we know that there are 3 exceptions to this general rule. What are these 3 exceptions? What do you mean by exceptions? Exceptions in the sense, these 3 assets, even though you do not have any impairment indicators, it's a must for you to do the annual impairment testing. On annual basis, you must do the impairment testing, which means annual basis you have to compute the recoverable value and see that whether there's any impairment loss to be recognized, even if there are no indicators. What these three items are? All these three items are actually, remember, intangible assets, relating to intangible assets. First one, if you have a cash generating unit with goodwill figure, there's a cash generating unit where a goodwill figure is allocated. Second one, intangible assets with indefinite useful life. If you believe that this asset can be used for an indefinite period of time, so there is no amortization that you recognize in the P&L because the use is indefinite. As there is no amortization, what the standard says is it's a must for you to do the annual impairment testing, even though the indicators are not available. Third one is the most important one. That is also an intangible asset which are not yet available for use. Can anybody tell me what do you mean by intangible assets which are not yet available for use? What is it? These are the intangible assets which are in the development stage. When a particular intangible asset is in the development stage, right, it is not yet available for use, which means there is no amortization because the amortization starts once the development work is over. As there is no amortization, yet again, what the standard says is it's a must for you to do the annual impairment testing. So if you have any indication, if the answer to the question yes, yes, you have to do the impairment testing. This is the normal rule. Even though there are no indicators, for these three items, what you need to do is annual impairment testing is a must. Impairment test at least on annual basis. This annual impairment testing can be done at any time during the reporting period. A lot of people are doing that at the year end, but it's not mandatory. You can do it at any time during the year, but it has to be consistent. If you do it on 30th June, each year it has to be on 30th June. If you do it at the year end, each year it has to be at the year end. Then other items, assets and the cash generating units other than above, we go ahead with the normal rule. What is the normal rule? If you have an impairment indicators, if the answer to the question is yes, you do the impairment testing. If you don't have any impairment indicators, if the answer to the question is no, no impairment testing, right? So as I said, that examiner can combine a question in terms of the intangible asset and the impairment of asset standard because there's a connection in between these two areas I have discussed, especially the impairment testing of these three intangible assets. Right. Now I am going to one of the important area of the case study. Please, this has been taken directly from the case study. As I said, I'm not going to go the case study and read it because we can spend time effectively. Have put everything what is important in the case study into the PowerPoint presentation itself. Read this particular small para by yourself. What it says. Company QEP has invested highly integrated IT system which connects restaurants, couriers, that means drivers, and consumers, end users, right? This system requires extensive connectivity to offer efficient services to the customers, right? Now, in this particular matter, we should be careful or we should understand what is the business model of this particular company and what is the revenue recognition model of this particular company. Now, as per the revenue recognition standard, we look at in a little while here, actually it's there. So as per the revenue recognition standard for any business, what we need to do is we have to apply the 5-step revenue recognition model. Right? What is step number 1? Identify the contract with the customer, agreement that you have with your customer to provide goods and the services. Then what are the performance obligations in that particular contract? What are the distinct performance obligations within the contract? What is the transaction price? Step number 3. Then allocate the transaction price to each of the performance obligations. That is step number 4. And step number 5 is recognize the revenue once each particular performance obligation is satisfied, where you have two models over the time and point in time. Out of these 5 steps, in this particular case study, as per the given information, I don't know what will be available in the unseen, as per the given information in the pre-seen, step number 2 and step number 5 are equal. Why do I say so? You need to identify what is the performance obligation of this company. What is your business? You have a mobile platform. Through that, what do? You connect merchants and couriers with the end customer, right? So think about what is, you know, by reading this case study, you understand that this is actually the model followed by, similar to the model followed by Pick Me and Uber, right? We have real life practical examples. So what do they do is they actually connect merchants and the drivers with the end users to facilitate a successful transaction. So most of the time, that's what they do. Now, in that situation, what is the concept that you need to look at is in that particular arrangement, whether Quick Eats, our company, is whether it is the principal or whether it is the agent. You have to identify your performance obligation. What you need to do actually, what is your responsibility? What is your enforceable obligation here? So depending on that only, you can decide you are the principal or you are the agent. Principal means what? You provide the goods and services by yourself, right? It is your responsibility to deliver this particular good or service. Agent mean you arrange for the provision of goods and services by another party. Other party is the party who provide the goods and services. You arrange that particular transaction. You facilitate that particular transaction. Then you are the agent. So are we the agent or the principal? Because why? If it is the principal, you have to follow the gross basis of recognizing the revenue. Whatever the price that you collect from the end user would become your revenue, gross basis. On the other hand, if you are the agent, your revenue recognition has to be the fee or the commission that you earn. Now, my question to you is, what do you think? In this particular situation, Quick Eats PLC is the parent company, sorry, is the principal or the agent, depending on the information given in the question, right? Because why there can be different models followed by the company. So in one business model, you can be the agent. In the other business model, you can be the principal as well. You have to look at it carefully. Okay. So for you to understand this, because in the Sri Lankan context, we don't have any published sources look at this, right? Because we don't have any annual reports. There are no public quoted companies which are listed and doing this business in Sri Lanka. So without that, what I did was I have taken this particular document. This is actually the annual report of Uber Eats, right? So US company annual report, even though it is US gaps, doesn't matter. This particular area, actual revenue recognition standard was developed with a joint project by IESB and FASB some years back. Okay, so because of that, this particular area are almost similar in terms of the IFRS framework and the US GAAP framework. So it's a good source for you all to refer. This is available in the internet, right? Even I can share that with you later on. So there, let's read it, the relevant section and understand. This is the way that you learn, right? Not to be parrots and say that we are the principal or we are the agent. But let's analyze in detail and see. Right. I'll go to straight away the relevant page. This particular matter is discussed. Take a couple of minutes by yourself and read what I've highlighted. There you'll be able to understand most of it. Right. Have you read it? Okay. Understood? If it's understood, that's great. Otherwise, I'll help you. We derive our revenue from service service fees paid by drivers and merchants for the use of our platform in connection with our mobility products and the delivery offering provided by drivers and merchants to the end users. So here, what is important for this particular company is only the delivery of food, right? So mobility is not applicable, right? So basically, what it says is company recognize the service fee paid by the drivers and the merchants for the use of their platform, right? In terms of the delivery offerings provided by the drivers and the merchants to the end users. Actually, the service is provided by the merchants and the drivers. For that purpose, we allow the merchants and the drivers to use our platform, right? So the next sentence, clear it out. Our performance obligation in the transaction is to connect drivers and merchants. So what is our obligation? What is our obligation? By highlight, connect drivers and merchants with end users to facilitate the completion of successful ride hiring, trip, or a delivery. Is that clear? So here what it says, the performance obligation of the company in this situation is mainly to facilitate the drivers and merchants to connect with the end users and provide the delivery service. What do you mean by that? So are we the principal or are we the agent? As with the information explained up until now. So you are the agent here, right? But by saying that, it also says that in certain market, we also generate revenue from the end users and charge a direct fee for use of the platform in exchange for mobility and delivery services. So our main business model is to what? We connect drivers and merchants with the end users through our platform to facilitate a successful transaction. In that case, I am an agent. So that if I am the agent, my revenue has to be recognized on net basis. What do you mean by net basis? In terms of the merchant, now let's say there's a particular food item. It is displayed the price as 1,000 rupees, right? And let's say there's a delivery charge depending on the customer location. Let's say another 150. Altogether, how much? 1,000 is the price of the food and 150 delivery charges. So when you facilitate this transaction, customer will pay 1,150. That 1,150 is not to be your revenue. Your revenue would be from the merchant, you get a commission. Now, if the price is 1,000, let's say you agree a commission of 20% with the merchant. So the percentage would vary. In that case, when you sell a product through your platform, which has a value of 1,000, you will be getting a 20%, means what? How much of a commission fee that you are getting? 200. Your revenue would be that 200. Similarly, again, depending on the case by case basis, let's say out of the delivery charge, so the total amount paid by the end customer, end consumer is 150. Out of that, let's say you pay the rider only 125. Let's say you keep 25. So what is your revenue? 25 is your revenue. Net basis, fee or the commission that you entitled. Right? Are we clear? But that is the main business model. But in certain situations, what can happen is you take the responsibility of the delivery. Right? You take the responsibility over the delivery and you deliver the product. Because in this particular question, in this particular case study, in the pre-scene, it was clearly mentioned there are two types of drivers. You have independent contractors, freelancers, as well as your own drivers, own pool of drivers. Might be In terms of this own pool of drivers, sometimes you take the responsibility to deliver the product and you have an agreement with the end consumer to actually get the particular product. In that situation, that is what it's mentioned in this particular line. What it says, in certain markets, we also generate revenue from end users and charge a direct fee for the use of the platform or exchange for the mobility or the delivery services. You charge a direct fee from the end user, where you take the responsibility over the delivery. In that situation, the amount of the money that you collect as the delivery fee would become your revenue. There, you are the principal in terms of the delivery arrangement, not in terms of the particular food, right? With regard to food, it is very rare you become the principal. You can't prepare the food. But in terms of the delivery, you need to be careful. In certain arrangements, in terms of the delivery, you can be the agent. In certain arrangements, in terms of the delivery, you can be the principal. Accordingly, you need to decide whether I'm going to recognize my revenue on gross basis or the net basis, right? Then continue to read that judgment is required in evaluating the preparation, judgment is required in evaluating the presentation of revenue on gross versus net basis. Whether, so how do you make that decision? Whether we control the service provided to the end user. If I am controlling the service provided to the net user, I told you in certain situations, you can have a direct agreement with the end user and you are the one who deliver the product. You take over the delivery service. In that case, you have the control over the delivery service. There you are the principal. So if we have the control over the service provided to the end user, there we become the principal in the particular transaction. So you recognize the revenue on gross basis. On the other hand, if we arrange other parties to provide the service to the end user, especially for the merchants, obviously for the shops which provide these foods, for them, we definitely, what we do is we arrange the transaction. We actually facilitate the transaction. In terms of the restaurants, we are definitely the agent, right? We are definitely the agent. So our revenue would be the fee or the commission that you pay, right? So that's why if we arrange for other parties to provide the services to the end user, then we are the agent. We have recognized the revenue on net basis. Are we clear with that? Are we clear with that? And also, so here in this particular report, page number 65 is a report highlighted, right? Page number 65. And the other page where you have detailed information is there. Yet again, I have highlighted the relevant areas. So I'm not going to go through everything. So read this particular paragraph. These Uber service activities are performed to satisfy our sole performance obligation in the transaction, which is to connect drivers and the merchants with end users to facilitate the completion of the successful transaction. So the main activity that they do is actually connect the merchants and the drivers with the end users and facilitate the transaction in that particular situation, both with regard to the merchant and with regard to the drivers. You are acting as an agent. Whatever the fee or the commission that you earn, you have recognized as the revenue. We are on net basis because we are the agent. But as I mentioned earlier, there can be arrangements, especially in terms of the delivery. You can take the control over the delivery. You would become the party who is primary responsibility over the delivery process. In that case, what happens is you would become the principal and the revenue to be recognized on gross basis, because in the case study, again, if I remind you, there are two types of drivers. There are independent contractors and there are permanent drivers. In terms of the permanent drivers, so that you have to look at the information what is given in the unseen, right? I'm predicting a question where examiner can give you is in terms of the permanent drivers, examiner might say that, okay, you take over the control over the delivery process. You agree a fee with the customer. So then whatever the fee that you collect, the entire amount from the customer is your revenue because you are the principal, cross. And the salaries, what you pay to these drivers, because they are normal employees of the company, they are in your payroll. Whatever the salaries that you pay, you charge that to the cost of sales. But In case of the independent contractor, what you do is you just facilitate them, right? You don't take the control over the delivery. You facilitate them. Anybody can register as an independent contractor. So they do the delivery. So your revenue in that situation is by facilitating the transaction, you earn a commission or a fee. So that would become your revenue where you are the agent, right? Where you are the agent, you recognize the revenue on net basis. In terms of the merchants, restaurants, most of the times you would be the agent. So by facilitating the transaction, you get a commission fee, a percentage of the selling price. That is your revenue. Where you are the agent, you recognize the revenue on net basis. Are you clear? So I'm not going to go through the entire thing. So I now told you the reference. So this is this particular page from here, from revenue recognition. This is actually page number 87. So read these, highlighted area which are with you. And also in the next page, you read the delivery part only, right? Because in this particular example, mobility is not applicable because our example is about food delivery. But Uber provides other services, right? So they provide mobility services as well, but not relevant to this particular case study for the previous. So you read these two pages, page 7 and page number 88 of this 2023 annual report published by Uber. Even though that's a US company, US GAAP is the applicable GAAP, but doesn't matter. So this particular area, so what is applicable in IFRS and US GAAPs are almost similar. You can refer this. That's why I said that. So it's not a conventional session. I actually wanted to go into detail and analyze the stuff what is there in the pricing. This is one of the examples, right? As we don't have any companies in Sri Lanka which are listed in this business, so I want to trade this particular source document, right? Let me go back to the presentation. Right. So what are we discussing? We are discussing the application of what? SLFRS 15 to the pre-seal. So one area of application, as I mentioned, step number 2, identifying the performance obligation. When it comes to the performance obligation, you have to decide whether you are the principal or the agent. Now I have explained that. Okay. Then the next area of the question can be in relation to this particular subsidiary because they have two subsidiaries, right? So the first one is with Eats IT Private Limited. So this is what they do, right? What do they do? Company was established to provide IT services to the group. Quick Eats IT is in charge of the mobile app, so they have the primary responsibility of the mobile app, functionalities of the application, as well as the data storage. Directors of the parent, that is Quick Eats, believe that if one company can take the full responsibility on the IT side, Quick Eat PLC, that is the parent company, can focus on growing the business. So that's the purpose of establishing a separate company who is responsible for the IT services. In addition to providing IT services to the group, Quick Eats IT Private Limited provides IT services to the other companies as well. So they provide services to the parent company as well as the other companies. Now, here, what is the performance obligation? Services that they provide to the parent company and the other external parties. So in terms of the revenue recognition model, what you need to look at is actually the step number 5 here. That is recognizing revenue once the performance obligations are satisfied. With regard to step number 5, as I explained earlier, there are two ways of recognizing the revenue. In certain performance obligations, you recognize the revenue over time. In other cases, you recognize the revenue point in time. What do you say about the IT services? Let's say if it is conventional monthly services like system maintenance, IT support, so those activities are falling under recurring services. You need to recognize the revenue over a period of time, right? Because why? So in the standard, if I go to the standard technical aspects, what the standard says is when you have a performance obligation, you need to first of all look at whether the particular performance obligation is satisfied over the period of time. You conclude that the particular performance obligation is satisfied over the period of time or over time if one of these three conditions are met. What are these three items? So actually, in terms of the IT support services, regular maintenance work, the first condition is satisfied. What is that? Seller is providing the service and customer or the consumer is consuming or receiving the service simultaneously. In this case, IT company provide the service either to the parent company or the external parties, and the consumer is consuming the service simultaneously. So that you need to recognize the revenue for a period of time. That is the first one. Second one says that why do you now satisfaction of one criteria is enough, right? If the first one is satisfied over time, you don't need to actually look at the second and the third one at all. You don't need to. But there can be another business which is undertaken by this IT company within the group is they may develop platforms or they may develop softwares for the parent company or else to the outsiders. In that case, what type of a performance obligation is this? So let's say you are developing a software for a client. You are developing a software or you are developing a platform, another mobile application. In that case, can you say that seller is performing the service and customer is consuming the service simultaneously? No, may not be. Then you need to look at, okay, what are the other two criteria? What is the second criteria? Seller create or enhance an asset. Yeah, during the creation or during the enhancement, customer controlling. Seller is constructing or enhancing an asset. During the construction, who should control it? Customer. In this situation, the example that I have given you, if your company is developing a software for a client, that particular customer might not be controlling it during the development, right? So the seller has the control. If the seller has the control, then the condition is satisfied or not, condition is not satisfied. So basically, this is not satisfied, this is not satisfied. Then we look at the third one. What is the third one? Important aspect. Seller's performance doesn't create an asset with an alternative use. So the seller's performance doesn't create an asset with alternative use. There's no alternative use out of this asset. That means this particular asset is specialized. So specialized only for that particular customer. It is valuable. Right? And not only that, seller has an enforceable right to the payment performance completed today. Not only that, it is so specialized. If 60% of the work is completed, seller has a right to collect 60% of the consideration. Customer can't say that, okay, it's not completed, I can't pay you. No. So seller's position is covered because why? If seller completes 60%, seller can request, so the seller has a right to collect 60% of the consideration. On the other hand, the particular asset is so specialized and there is no alternative use to the seller other than providing this to the particular customer. Now, in terms of the IT software platforms, this particular point is applicable, right? Most of the software, most of the platforms are so specific, so unique. Seller doesn't have any alternative use other than selling to the particular customer. And you can construct or you can come to an agreement in such a way to protect the position of the seller to say that, okay, if the agreement is cancelled for any reason, seller has the enforceable right to collect for the work that he has done. So in that case, what happens? Third condition is satisfied. You can recognize the revenue over the period of time. Recognizing the revenue over the period of time means you recognize the revenue based on the progress towards the completion. You have input methods and the output methods discussed in the standard to measure the progress towards the completion. I'm going to go into detail, right? So based on the progress towards the completion, you recognize the revenue over the period of time. Then if none of these three performance conditions are satisfied, there can be an arrangement. Let's say you are developing a software that is so unique, only that particular customer can use it. As per the agreed terms, the customer would make the payment at the end of the development work. If the contract is cancelled during the period, seller doesn't get anything. Because why? To collect money, he has to complete the work. Then only you can collect the money from the customer. In that situation, what will happen? So none of these three conditions are going to be satisfied. If none of these three conditions are satisfied, which means you have to recognize the revenue at a particular point in time. So what do you mean by point in time? Point in time means point at which the control is transferred. Again, I'm not going to go into detail. You have to look at these areas if you can't remember. So the standard specifies the indicators to say that the control is passed. There can be many indicators, whether the physical delivery is taken place, whether the legal title is passed, right? Whether the seller has a right to collect the payment, what has happened to the risk and rewards, whether it has been transferred to the customer, whether the customer has accepted the asset. All these things to be evaluated and decide, okay, this is the point at which control is transferred. If it is point in time, you recognize the revenue at that particular point in time. Are we clear? Are we clear? So that is the other area of the revenue recognition where it can be tested in terms of this information given in the pre-scene, that is more or less related to this Quick Eats IT company, right? Quick Eats IT Private Limited, right? Right. Then pre-scene also mentioned about another subsidiary. What is that? Quick Eat Riders Private Limited. This is again taken from the what you call pre-scene. Just read it and see that, okay, what is their business and what is the applicability of the standard. Just read this part. Quick Eats Riders Private Limited. Company manage fleet of drivers, driver recruitment, training, management, and other issues related to the drivers are handled by Quick Eats Riders. I told you at the beginning, so you even though you train people, you can't capitalize that cost. You have to charge that to the P&L because you don't have the control over that particular employee, right? So because of that, without having the control aspect, you can't capitalize the intangible assets. Here also, this particular company, so that is mainly to do the handle the drivers and maybe providing the service to the parent company yet again, right? So the services that they carry out on behalf of the parent company, they might charge a monthly fee, more or less, depending on the information given in the scenario. It seems that the performance obligation in terms of this recruitment, training, management are satisfied over the period of time, so that the revenue is recognized, revenue has to be recognized over the period of time, because seller means this particular company, Quick Eats Riders, performing the service, and the parent company is consuming the service simultaneously. The particular performance obligation simultaneously. In that situation, you have recognized the revenue over the period of time. And also, I wanted to explain you, as you have a parent company that is Quick Eats PLC, parent company, plus 200% owned subsidiaries, which are Quick Eats, Quick Eats IT and Quick Eats Riders. So this is a group. So that's why you have been given the pre-scene, the company accounts of Quick Eats PLC as well as the consolidation financial statements of Quick Eats PLC. Obviously, and also we looked at there are transactions taken place among these companies. So basically, both subsidiaries are providing services to the parent company. There are transactions. And also, if you look at the statement of financial position, there are related party balances, which means what is the stand applicable over here? LKS 24 related party disclosures. So whether you are following the disclosure, necessary disclosure requirements of the standard. This particular standard doesn't have any recognition of measurement criteria. It's purely a disclosure related standard, right? So you have to understand, because in this particular situation, it is very simple at the moment, right? But if a question is tested, there can be additional information in unseen. So you should understand what sort of relationships, what are the related parties of a particular reporting entity, what are the four types of relationships which would be considered as related parties in a particular reporting entity. So what I have put in the light blue are the related parties, and what I have highlighted in red is actually are the not considered as the related parties. Now, if you have a reporting entity, your subsidiary, so the reporting entity is this, what is there in this yellow color. So your subsidiary, 100% own or more than 50%, your associate, as well as if you have a joint venture, that particular joint venture. So this in this particular case, you hold 50% and some other investor holds 50%. You, that is our reporting entity, and this other investor jointly control the activities of the joint venture. Then the reporting entity and this joint venture are related parties. But remember, reporting entity and the other joint venture investor are not related parties, right? Okay. Then thereafter, your parent company. If you have parent company, that particular parent company, that parent can be an entity, that parent can be a person. If it is a person, they are close to members. Other related parties in the reporting entity. Similarly, if you are an associate of another investor, so an investor is holding 35% of shares of you. Then this particular investor, it again can be an entity, can be a person. If it is a person, therefore that particular person's close family members would become what? Related parties for the reporting entity. Then your parent company can have another subsidiary. Now, for example, if you look at Quick Eats IT and Quick Eats recruitment services, so what is the relationship between these two companies? These two companies are under the control of the parent company. So the parent can direct the transaction with regard to both companies. So because of that, they are related parties. IT company and the recruitment company are related parties. So that is what is mentioned over here. So this is your parent company, this is your parent company, and you are a subsidiary. Similarly, parent company can have another subsidiary. That subsidiary and you are under the control of the parent company. So because of that, there is our reporting entity and that subsidiary of the parent are related parties. Similarly, your parent can have an associate. Your parent can enter into a joint venture. That particular associate, that particular joint venture are related parties to you. Right? So the concept is broad. Not only that, now when we talk about individuals, people, key management personnel of our entity. Right? Key management personnel means the definition is people who have the authority and responsibility to do the planning, directing, and controlling of the activities of the company. Your board of directors, both executive and non-executive directors, as well as senior management is considered to be the key management personnel of the particular entity. So these key management personnel of the particular entity, as well as close family members of these key management personnel are related part to the reporting entity. Not only you, not only them, key management personnel of parent company, not the key management personnel of your entity, not the reporting entity's KMPs, but the parent company key management personnel. And close family members of the parent's key management personnel become related parties to you. Right? Is that understood? So these are actually people, individual. Then, if any of these people, it can be KMP of your entity or their close families. It can be KMPs of the parent company and their close families. If any of these people are having a subsidiary, associate, or a joint venture, that particular subsidiary, that particular associate or joint venture would become a related party to the reporting entity. So that's why I said that for the definition, for the identification of the related party is a critical thing. It is broad. So once you identify the related parties, you have to make the necessary disclosures about the transactions, balances, allowances what you made, terms of the transactions. So all these disclosures are mentioned in the standard to be made in terms of the identified related parties. So because of that, I thought of highlighting this particular standard as well can be tested in terms of the information you are in the RC. Right. Okay. Then, if you look at this freezing, in the freezing, you have been given 6 types of key risks that they have identified, and also the action taken by the company against each of these risks. I'm not going to go through each and every one. If I, look at the main points, one is demand for the fast food can be declined if customers are thinking about healthy diet. Demand for the fast food that this particular company platform is facilitating to deliver can decline. Then dependency on the brand reputation of the restaurant partners. As for the case study, so the Quick Kids PLC has partnerships about with 300 food providers. So reputation of the platform is depending on the brand reputation of these restaurant partners. So which is not within your control. If that reputation declines, it has an impact on your business as well. Again, data privacy as customers' personal data is stored. Now, in the platform, there's a data center. In that data center, personal data of the customer is retained. So, there are a lot of regulations in terms of the data protection. There are new laws which have been introduced so that there can be a liability of the entity, that can be a reputational damage on the entity, saying that you are retaining or using or doing business activities which affects the privacy data of the individual. That is also a risk. Then restaurants may terminate their contract with the Quick PLC. I told you there are about 300 restaurant partners, right? So always for them to be part of your business transactions, you need to add value to these partners. If they leave or if they terminate the contracts that they have with you, that would have a detrimental impact on your business. Risk of system failure. There can be possibilities of cyber attacks because these are tech-driven company, IT-based company. So even recently there was cyber attack. That risk is there. Plus, always there's a risk of countrywide business disruption. So this is there for any business, but it is affected in different way in terms of an IT business. Okay, so the damage will be much higher comparing with the traditional business. So what I want to tell you is I'm not going to analyze this risk in detail because as I mentioned in this presentation, what I'm covering is the area related to the financial reporting, which is 55% of the syllabus. So risk governance and ethics part is done by, actually the session done by lecturer Suranga. So he has done the session. So the point what I wanted to mention is this particular paper, ABR paper, SL1 paper, look at the things from a CFO's point of view. Because when you become a CFO, just having the knowledge about the accounting standards and the consolidation is not enough. Because why I say so is now you see that there are certain business risks which are mentioned in this particular briefing. When you have a business risk, obviously what will happen is it will be reflected through the material statements in the financial statements. What you need to understand is examiner can give you a question connecting these two areas. Business risk lead to a risk of material misstatement. As a CFO, how do you identify it? And what are the areas in the financial statement? These would be reflected. Now, if I take an example, one example over here, when you have a data privacy risk, what can happen? There can be litigations. if there are litigations, if you become guilty of that particular situation, you have to make the payments. Now, you need to look at whether you have such situations because there's a business risk. That particular business risk can lead to a risk of material misstatements in the financial statements. So what is the risk of material misstatement? Whether you have correctly recognized any provisions. Have you disclosed the contingent liabilities? If there are cases that you need to be worried about, right? So now, as I mentioned, as it is mentioned about the data protection, examiner can give you a scenario where there's a litigation. So through this litigation, company need to make a provision. So then in case 37, provisions, contingent liabilities, and the contingent assets can be applicable. Yeah. What should you look at is if I need to make a provision, there should be three conditions to be satisfied. What are three conditions? There should be a present obligation. At the moment, there should be an obligation. That particular obligation can be a legal obligation or constructive obligation. As a result of a past date, we look at it in little while and quickly explain what is legal obligation and what is constructive obligation. And in this scenario, what type of an obligation that may arise, right? There should be a present obligation as a result of past event. Then the outflow of the economic benefits should be probable. Probable means more likely than not. More than 50% chance is there to happen that outflow. And also the rupee value amount can be estimated reliable. If these three conditions are satisfied, we need to recognize the particular provision in the financial statements and we need to make the necessary disclosure. You see, there's a business risk that can lead to a risk of material misstatement in the financial statements if the provision is not recognized in a situation where provision should have been recognized. Okay. So then I told you this particular present obligation can either be a legal obligation or else it can be a constructive obligation. The legal obligation is arose due to a contract that you have entered into. If you violate the contract, or because of a law passed in the parliament, because of a court case, court order, legislation. So these are the situations where legal obligation will arise. Actually, in this particular situation, if it is in terms of the data privacy, it is a violation of regulation. So more or less, if it is an obligation, present obligation, that would be a legal obligation. Then constructive obligation means what? You create valid expectation in the minds of the other people that you discharge or undertake certain responsibilities. You create an expectation in the minds of the other people that you would discharge certain responsibilities. So that would arise because of the established pattern of past practice, because of the published policies, or because of a sufficiently specific current statement. So I'm going to go into detail, but here you create a valid expectation in the minds of the other party. You have to recognize a provision, yet again, satisfaction of, or based on the satisfaction of three criteria, what is mentioned over here. And there you need to make a judgment about whether I should make a provision here or should it be should it just be a disclosure or should it be actually a liability? Because what is the difference between the provision and the liability, by the way? Very simple question, right? Provision is also a liability, but it is uncertain in timing or amount or both. There's certain amount of an uncertainty in terms of the provision. So because of that, provisions are measured at best estimate. Now this table summarizes the accounting treatment in terms of the degree of probability of cash inflow and the outflow. In terms of the liability, it is a cash outflow. In terms of the assets, it's a cash inflow. This particular table explains you the concept of prudency as well. Why? If something is virtually certain, what do you mean by virtually certain? Almost there. Right? Normally we believe if something is 95% or more, it is virtually certain. Right? Industry practice. So if a liability is virtually certain, you have to recognize the liability to provide it. If an asset is virtually certain, you have to recognize the asset. Then probable. What do you mean by probable? If I go to the next. Right. This is the word, only word out of these four which is defined in the standard. The word probable. How it is defined? More likely than. What do you mean by more likely than what? More than 50% chance. Right? More than 50% chance is there to happen. It can be 50.1% even probable. Now, in terms of the probable outflows, you recognize, you provide. That's what we learned, right? In terms of a provision, to recognize the provision, it has to be a probable outflow. If there's a liability which is probable, we provide. But let's say there's an asset which is probable. Are we recognizing it? No, we just make a disclosure. Okay, we just make a disclosure as a contingent asset. You see the prudency, right? If a liability is probable, provide, but an asset probable, you just make a disclosure as a contingent asset. Then what about the possible? What will be the possible? Possible means what? 50% always. It can be 50 always. In terms of the liabilities, possible liabilities are disclosed as a contingent liability. If an asset is possible, what you don't disclose. Again, prudence would come into play. If it is remote, both liabilities and assets, remote means 5% or less. So both liabilities and assets no disclosure. You have to apply. If a question is tested in terms of this area, you have to correctly apply the accounting treatment in terms of the, especially in terms of the liabilities. Is it virtually certain, probable, possible, or remote? Depending on that, what is your accounting treatment? Right. So then what I was discussing is this particular risk. Now, at the same time, there can be many risks which can crystallize. Let's say there's a data protection issue. Then there are court cases against you. Now your reputation got damaged. Their restaurant partners cancel or terminate their contract with you because you are in bad records. That would have an impact on the business. Right? So, and also there are certain site attacks as well. It is now regular. All these cause might cause you to think about your going concern assumption as well, because as information is given in the question about these risks and the mitigating activities that the business has taken, examiner can give you a question where sometimes there may be a question mark on your going concern assumption, because in LKS 1, presentation of financial statement standard says that when you prepare the financial statements of a particular entity, you need to check that, management need to check that whether the going concern assumption is valid. That means entity can exist for a foreseeable future. At least you should be pretty sure that from the reporting date, at least during the next 12 months, company continue to do the business. There's no closure, there's no liquidation. When companies preparing the financial statements, if you have any uncertainties about going concern assumption, what entity has to do is, let's say entity has decides going concern assumption is still valid. There's no question on that. But there are material uncertainties. So the examples that I have given may lead to material uncertainties. So those material uncertainties need to be disclosed. And if the impact is so severe, and if entity decides that going concern assumption is not valid, then you can't prepare the financial statements by using the going concern basis. You have to follow an alternative basis, maybe the breakup basis, where all your assets you classify as current assets. There are no long-term assets. There's no long-term existence for the business. All your liabilities as current liabilities. Then the assets are valued at realizable value. At what price I can sell these assets? So you have to make significant changes in the preparation and presentation of financial statements. You should be aware about that, as these risk types have been included in the pre-scene discussion. Okay, right. Right. So I have explained important aspect in terms of the accounting standards. As I said, there are 4 areas in terms of this particular presentation. Now we have completed 2 areas. One is about the company. So the parent company, what do they do? Who subsidiaries, what is their business model? And also the business model as well as the revenue recognition policies to be followed by each company we looked at. So about the company we looked at, then we analyzed what are the applicable accounting standards based on the given case study or based on the given reason. Then at the end also again, once I go through the financial statements, statement of financial position and the statement of profit or loss and OCI, again I will highlight certain other applicable standards as well. But based on the information specifically given in the PC, these are the areas what I have discussed that is important in terms of the accounting standards. Then our discussion is not yet completed because while two more important areas are yet to be completed, that is actually two main areas in terms of the question number 3 of the paper. One is consolidation. What are the possible consolidation questions where examiner can test in terms of the consolidation, as well as analysis and interpretations. If you look at last two papers, there were questions in terms of the analysis and interpretation. How an investor analyze the financial statements. You can remember the DuPont analysis that was tested consecutively last two times. Right? What are the other analysis? What are the special things of the financial statements that you can see if you are a tech-based company? In addition to the accounting standards, there are certain interpretations. One interpretation is actually 632. So which we will discuss. So basically two areas are pending, consolidation and the analysis and interpretation. What we can do is we'll take a short break, maybe a break of 20 minutes. Would that be all right? So we take a 20 minutes break, but ensure that your participation to be there up until the end of the session because two most important areas are yet to be discussed. So we'll take a break of 20 minutes. After 20 minutes, I will start the consolidation first and thereafter the analysis and the interpretation part. Okay, right. Hope you're back. So let's start. As I said, we have completed about the company business model and there are the accounting standards. Now what we are going to look at is consolidation, right? One of the important area for the pre-scene analysis. So as per the pre-scene information, we already discussed that parent company is Quick Eat PLC, which has two subsidiaries, fully owned subsidiaries, 100% owned subsidiaries, Quick Eat IT and Quick Eat Riders, right? So this is the current group structure, what is given in the pre-scene. Now this is actually, this has been taken directly from the pre-scene. Why it says, if you need to, can you read this particular statement that gives a hint about the growth strategy, which is to be followed by this particular organization. Board directors, that means two brothers, initial directors, think that quickest option to enhance the value is to acquire existing businesses rather than building new business lines from scratch. That means they want to grow through acquisitions rather than organic growth. Due to their liking for food, they like to consider options such as acquiring restaurant chain and lean luxury hotel. So they want to do the related diversification, food related business. One is restaurant chain, the other one is luxury city hotel. There are two companies it was mentioned over here. One is Colombo Plaza Restaurants and City Hotel, right? CPRH, Colombo Plaza Restaurants and City Hotels. And the other one is Palace of Seafood, POS. Are two options available to Quick Eats PLC. So these are two possible targets for the Quick Eats PLC because these are related to food and they want to go through acquisition. Then you have also been given recently, somewhere else in the pre-scene it was mentioned. Recently, Steve got to know that the main shareholder who owns 70% of CPRX. CPRX means Colombo Plaza Restaurants and City Hotel. Wants to sell its stake in the company. 70% shareholder, major shareholder of the company wants to sell its stake. Balance 30% is owned by another shareholder who seems to have an interest in the holding. A share percentage CPRX. So that means the balance is held by minority shareholder. So 30%. It seems that he wants to have, he wants to hold his interest, right? 30%, 30%, or maybe a little bit lower than 30%. But he doesn't want to fully exit on the business, right? Once you connect these two information, what you can derive a scenario, a clear-cut scenario can be just in the exam. Examiner can give that Quick Eat PLC will acquire what 70% shares of Colombo Plaza Restaurants and City Hotels. Maybe balance 30% would be retained by the minority shareholder. Sometimes maybe even the minority shareholder may sell 10% out of its holding and retain 20%. Right? In that case, Quick Eat PLC would acquire 70% from the major shareholder, 10% from this minority shareholder, 80% or else directly the easiest possible is actually to acquire the 70% holding of the main shareholder who wants to sell his stake of the company. If that is the case, what will happen to the group structure? So you have two fully owned subsidiaries. Quick Eat PLC already has Quick Eat IT and Quick Eat Riders 100%. That is given in the pre-scene. And the 70% ownership of this particular company, CPRH, will also be acquired by Quick Eat PLC. That will become a partly owned subsidiary of Quick Eat PLC. Right? So if it is acquisition, I believe that this acquisition would happen through with PLC, because there's no reason as the information given in the PC to acquire that through the IT company or else through the wiki writers, right? So there's no strategic reason. So most probably if it is an acquisition, that acquisition would happen. CPRH acquisition would happen through wiki PLC. So in that case, we should be ready to do the computations like goodwill computation. When you're doing the goodwill computation, you need to fair value the acquired subsidiaries net assets. So this fair valuation adjustment would trigger a deferred tax impact. You should know how to adjust the deferred tax impact of these value adjustments, right? Then the consideration might be paid in different means. Part is paid by cash, part is way of some other means, maybe issuing shares. So then there can be a question in terms of the measurement period adjustment. There can be a question in terms of the bargain purchase. So all possible scenarios in terms of the acquisition we look at, right? So that is one possibility. So if that is happen, actually Quick PLC would have three subsidiaries, 41 subsidiaries, and another subsidiary which has 70% holding, which means with regard to that subsidiary, you have to recognize the non-controlling interest as well. At the moment in the state of financial position, you don't have any non-controlling interest because why? Both subsidiaries are 100% owned. But if you acquire 70% of CPRH, obviously you would have 30% non-controlling interest that also to be calculated as one adjustment, one working in the particular question. Hope it is clear for you. That is first possible scenario. Then we have this particular information. Now the information during the PC. White says there are two owners owning equal share percentage of balance of seafood. What we mentioned over here, POS, balance of seafood. That is the name of the company. That is another target company that Quick PLC or the Quick Group is looking for. Now, if you look at the shareholding structure, there are two owners who own equal share capital, equal percentage of balance of seafood. One owner is a director who is also the lead chef. So the one owner is the director as well as is the lead chef, right? The other owner is currently not well and plans to sell his 50% stake in the business. Other owner plans to sell his 50% stake in the business. What would be the scenario? So that other owner will sell this 50% to Quick PLC. In that case, what will happen? 50% shares of POS will be held by Quick PLC, and the remaining 50% is held by the other shareholder who is the lead, right? The owner who is the lead prefers to find the strategic partner who can collaborate and support him to grow the business, right? So this particular lead chef wants to find a new partner who is a strategic partner who can collaborate and support him to grow the business. So what is the likely scenario? If you look at the current structure, Quick PLC has two fully owned subsidiaries, IT company and the riders company. What can happen is this new company has some seafood, right? So Quick PLC would acquire 50% of balance of seafood. And the remaining 50% is held by the lead chef, who is an existing shareholder as well as a director. Now, in this situation, what can happen? Highly likely situation would be this balance of seafood would be classified as a joint venture. So there's a joint arrangement. There are two types of joint arrangements, right? As per SLFRS level, there can be joint operations or there can be joint ventures. So this one is a joint venture because there's a great company, balance of seafood, and joint venturers are having the right over the net asset of this new entity. They are separate entity established. In case of a joint operation, there is no separate entity. Venturers are having the rights over the individual assets and liabilities. But here, the separate entity is formed. It is already there actually, right? And the venturers have the right over the asset of this entity. That's of zero. If it is a, you have to evaluate the criteria. What is the important criteria? If it is a joint venture or any types of a joint arrangement. Parties or the ventures, that means in this situation, we keep PLC and this other investor, other venture should have the joint control over POS. What do you mean by the joint control over POS? Decisions in terms of the relevant activities of POS are made with unanimous consent. So the relevant activities means activities which significantly affect the return of the POS. Those are decided with the unanimous consent of QEB and the other investor with the lead check. That information what is available in the ANSI. Because there can be situations sometimes, even though Wiki PLC acquired 50% holding of POS, right? 50% holding of POS, relevant activities are decided by the lead check. In that case, you don't have any venture. You just have 50% is not enough to say that it is a joint venture. What is important is to see that whether the decisions are made with unanimous consent in terms of the POS. Because depending on the information during the unseen, it can be mentioned that even though the shareholding is equal, either this particular investor with the lead chef and the existing director, or else Wiki PLC is making the decision about the relevant activities without the unanimous consent. If the relevant activities are decided without the unanimous consent, if one party is deciding the relevant activities, in that case, the particular party has the control, not doing control. Whoever has the control to consider the POI as a subsidiary. But according to my belief, what is most likely is after this transaction, PLC and the other investor should jointly control the activities of POS. Should jointly control the activities of POS. Is that clear with you? Right? In that case, it is a joint venture. If it is a joint venture, what is the accounting treatment? What is the accounting treatment for joint venture? LKS 28, investment in associates and joint venture. What is the accounting treatment? Equity accounting. Equity accounting means in the statement of financial position, cost plus share of post-acquisition net asset change. In the statement of profit and loss and other comprehensive income, share of profit after tax and share of other comprehensive income. Are we clear? Is my voice clear? Can you hear me? Please respond. Right. Okay. Okay. So it says that sometimes it's breaking. So I hope you understood what I have explained, right? So there were two scenarios. There were two scenarios, right? In the first instance, Quick Eats PLC is acquiring 70% ownership of CPRH. In that situation, CPRH would be considered as a subsidiary of Quick Eat PLC, where 30% would be held by an uncontrolling interest. That is one possibility. Second scenario would be Quick Eat PLC will acquire 50% holding of Palace of Seafood, and the other investor holds the remaining 50%. Then the Palace of Seafood would be considered as a joint venture. Relevant activities of POS is decided with unanimous consent of both investors, Quick Eat PLC and the other investor. So if it is a joint venture, you have to count that joint venture as per case 28, investment in associates and joint venture, investment in associates and joint ventures by using the equity account. But I told you, shareholding percentage is not enough. You have to clearly look at in the unseen whether it is mentioned that decisions in terms of POS or the relevant activities of POS is decided with the unanimous consent of Quick PLC and the other joint venture investor. But if the unseen mentions that relevant activities are decided by one party, either Quick PLC or the investor, then it won't be a joint venture. So the whoever party take the decisions over the relevant activities actually has control over POS. But most likely scenario, as I mentioned, based on the information during the briefing, would be a joint venture over POS by the Quick PLC and the other investor. Right. But is it clear now, guys? So the explanation that I have made for the second time, was it clear for you? Is it still breaking or is it clear? These are very important aspects. Right, great. Okay, moving on. Right. So if the examiner is disciplined enough, that means if he follows the pre when he prepares the unseen scenario, I think the first two scenarios are the probable questions in terms of your exam paper. But in the past, sometimes, most of the time, sometimes we see that examiner is not disciplined enough. He sometimes gives something totally different in the answer. There are papers of that nature as well. Right. So because of that, I thought of including the third scenario as well in terms of the consolidation. Where now, if you look at Quick Eat PLC, the shareholding of Quick Eat PLC, at the very beginning, I told you two brothers, right? If I go back to the very beginning about the company, introduction of the company over here, it was mentioned Mark Pereira is holding how much? 32.5%. Mark Pereira is holding 32.5%. And the Steve Pereira is holding 32.5%. Right? And the public holding is 35%. So, which means even though this family-owned company, that means altogether 32.5% plus the 2.5% is out. 65% is held by the two brothers. Only 35% is outside. There can be a question in the exam where exam might say that due to some reason, it was not mentioned in the pre-screen and no indications, no it's not given due to some reason. So the public holding or shareholders who are having this 35% holding wants to sell down. Right? So this public holding can be acquired by another investor. Now, if it is acquired by another investor, right, let's go back to the place I was at. If that 25% is acquired by some other investor, he just has still 35% of PLC. 65% is held by two brothers. So normally having 35% won't give you the controlling interest. But yet again, in the unseen examiner might say that Mark and Steve has decided to give the control to this party because he's a reputed party which having knowledge about this operation, maybe a foreign investor who has knowledge. So the Mark and Steve, two brothers, has decided to give the control over the business to this new investor who is having 35% holding of the Quick PLC. In that case, what will happen? Control is established not in the way of shareholding. The shareholding is 35%, but via a share agreement. Via shareholder agreement, control is given to this new investor. That new investor will become the, if that is the case, new investor will become the ultimate parent of the PLC. As well as PLC is holding 100% of the IT company and the writers company, it would create a scenario for what? What will? Because why? From the perspective of the ultimate parent company, the new investor, who is given the control by a shareholder agreement, has a subsidiary that is Indian PLC and two sub-subsidiaries called Wiki IT company and Wiki Brothers. Okay, so but it is a limited opportunity where this type of question can be given. But as I mentioned, if examiner is disciplined enough to follow the quizzing, he would give you either two scenarios or both scenarios. So both can be given. Okay, so there can be an acquisition of a subsidiary, there can be a joint venture transaction. But if you want to check something totally different from the quizzing, you may come up with the idea of nature as the. So based on that, I have included this aspect as well into our discussion. Is that clear? I hope you understood about it. 1 second. 1 second. Right. So was it clear? So what I mentioned was, I have given a third scenario, as it was mentioned that again my line was breaking up. So I just want to explain this again. What it's mentioned is, if examiner is disciplined enough to follow what it was there in the quizzing, what he would give you is either of the first two scenarios or the both scenarios what I have mentioned. But sometimes he will come up with an idea, something totally new, right? But it was not given in the quizzing. Yeah, he would say that in terms of the Wiki PLC, 65% is held by the two brothers, the 2.5% each. And the remaining 35% is held by the public, as it's a public product company. For some reason, these 35% shareholders want to sell their stake. So that stake of the public holding is acquired by a new investor who is a strategic partner. And Mark and Steve, two brothers, decided to give the controlling power to this new investor through a shareholder agreement. Right? In that case, control is actually not in way of shareholding, but in the way of shareholder agreement. So through the shareholder agreement, relevant activities of Wiki PLC is decided by this new parent company or the new investor. So in that scenario, new investor has a subsidiary, Wiki PLC, having 35% of holding, 65% is held by the non-controlling interest, the investment held by the two brothers, and new parent company is having two subsidiaries as well, because Quick IT and the Quick Riders are subsidiaries of the new parent company. Is that clear? Is that understood? In whatever the situation, you have to prepare the consolidated financial statements from the parent's perspective. Now, in the third scenario, what I have given, in this case, the question would be, you will be given the financial statements of this new investor, and you need to prepare the consolidated financial statements from the perspective of new investor. If it is a couple of scenarios, if it is the first scenario, yet again, you will be given the financial statements of this new company, CPRH, and required to prepare the consolidated financial statements from the perspective of Quick Eat PLC. Right? even in this scenario, you have to give the financial statements of this new company, POS, and you need to prepare the consolidated financial statements from the PLC's point of view. You have two subsidiaries, and you can have a joint venture. Now you need to follow the equity account. Okay, so for the consolidation, normal consolidation rules to be followed. Okay, right. So these are the possible consolidation question that can be tested, that can be given in the unseen scenario. Now we discussed about the accounting standards, we discussed about the consolidation. At the very beginning of the session, we identified the important aspect about the company. Now I'm moving to the last area, and this is also an important area. If you look at our recent examinations, a lot of questions have been tested out of this area as well. So because of that, so let's be careful on this aspect as well. These are easy marks if it is tested, but you need to be very clear on how you need to answer for the questions. Analysis and integrations. Right. So let's analyze the set of financial statements given by the given in the preceding. You have been given the financial statements of the group that is actually in the preceding. You have CT PLC is the parent company and two fully owned subsidiaries, IT company and the equity traders. So you have been given the group financial statements. Current year is 31st March 2024 and the previous year comparative year 31st March 2023. We have been given the current year numbers as well as we have been given the comparative numbers. Okay. For the group, that is parent plus two subsidiaries. And also you have been given the company numbers, that is only the parent company, Quick Eat PLC. Okay, Quick Eat PLC numbers have been given. Right? There is, in terms of the performance, there's not much to highlight. But what we look at is, if you analyze the line items, because I explained about the accounting, possible questions from the accounting standards. But when you look at this set of financial statements, there are some line items which yet again trigger a question in terms of the accounting standards. So what are these line items? Starting from revenue, thereafter you have direct cost, right? So then you have gross profit, thereafter other income, after that selling and marketing cost, administration expenses, then you have other expenses, so you have profit from operating activities, right? So thereafter you have finance income. Now when it comes to operating activities, you have not taken the finance income and the finance cost. Right? Operating activities, results of the operating activities are given before taking into consideration of the finance income and finance cost. And thereafter you have been given the changes in the fair value of investment properties. Right? What is the applicable standard? LKS 14 investment property standard. You should know the accounting treatment for the investment properties. You have two models, cost model and the value model. So in this case, you have taken the value gains to the independent company or the group company as well as the group is following the value model as the subsequent measurement model. So they are the unrealized value gains and the losses are taken to the profit and loss statement. That's what they have done. Okay. Then you have the profit before tax figure, income tax expenses. Thereafter, profit for the year. Profit for the year. Then under the other comprehensive income, we know other comprehensive income items can be classified in two groups. Items which will not be reclassified to the profit and loss, and items which may be reclassified to the profit or loss. Here, what is included is only the items which will not be reclassified to the profit and loss. That means in a subsequent year, it won't be reclassified to the profit or loss. Right? What we have been given revaluation of land and building. What is the applicable standard? In case 16. So PPE items can be subsequently measured either at cost or by the revaluation model. Now in this particular situation, land and building, it seems that company is using the company as well as the group is using the revaluation model. Then the revaluation changes are taken to the other comprehensive income, so that it goes to the revaluation reserve. Right? Then you have actuarial gains and the losses of the employment benefit liability. What is the standard? In case 19, remeasurement component of retirement benefit obligations. Right? With regard to case 19, it talks about the employee benefits. It talks about different types of employment benefit, short-term employee benefits, long-term employment benefits, termination benefits, post-employment benefits. So out of that, what is the most important aspect is the post-employment benefit. There you have defined contribution plans and defined benefit plans. Right? Defined contribution plans mean things like EPF, ETM. You know the amount of the contribution that you to pay. Once you remit your part of the contribution, your obligation is over. But if you need to pay a gratuity at the time of leaving the employee from the company, or else if you need to pay a monthly pension after he leaves from the company, that may be determined based on his final salary and the number of years that he has served to the company, organization is having a defined benefit plan. In terms of the defined benefit plans, we know that there are certain items which you take to the profit and loss statement, like current service cost and past service cost, and the remeasurement component to take to the remeasurement component mainly consists of the actuarial gains and the losses, which is taken to the other comprehensive income. So that is what you have done over here. So in this particular year, you have actuarial loss in terms of the group as well as in terms of the company. Then you have been given the tax charged on this other comprehensive income. This is the tax charged on profit before tax, and the tax charged on the other comprehensive income is given. Then the other comprehensive income for the year, net of tax. Thereafter, total comprehensive income, which is actually the total of profit for the year and total of the profit for the year and the other comprehensive income, net of tax, 1,144 plus 9,153. So last year, 2 years as well as the company numbers, always what you do is you take the total comprehensive income by adding the profit for the year and the other comprehensive income final total. Then you have been given basic earnings per share. What is the standard with regard to earnings per share? In case 33, right? So in this case, there are no, it seems that there are no dilutive securities, potential loan shares. That's why company just disclose the basic earnings per share. If you have potential loan shares like convertible debentures, convertible preference shares, share options, you need to disclose, companies to disclose both basic earnings per share and the diluted earnings per share. And also you have been given the number of shares held by the company. In case in the unseen scenario, if you need to calculate the value per share, net asset value per share, you will take this number of shares into account to calculate the net asset value per share. Right, so these are the basic information what is given in the statement of profit and loss and other comprehensive income. Right. Right. Moving on. As I said, certain questions I'll take it at the end of the session, right, to avoid breaking the flow of the session. So don't worry about that. I'll be taking the questions. If I don't answer, then I'll be taking those questions at the end of the session, right? Okay, then moving to the statement of financial position. What are the highlighting aspects there? Starting from assets, non-current assets. So let's write down the relevant standard for each of these line items, property, plant, and equipment. In case 16, right of use the asset. So in this case, even though no information in the preceding is given in terms of the description of the leases, this particular company is having a lease, right? That's why they have a right of use asset on the balance sheet. On the other hand, under the liabilities, there are lease liabilities, right? So which means what is applicable standard here? IFRS 16 leases. So as a lessee, you will recognize all leases. Now there's nothing called operating or finance leases for the lessee. It's a lease. No classification as operating or financing. All leases except for the two exemptions. You need to take it to the books. You have recognized the lease liability and the right of use. Yes. What are the two exemptions? Low value items and the short term leases. Other than these two, all other aspects of the leases to be taken to the books. The investment properties we discussed. LKS 14. So LKS 14. The intangible asset we have already discussed. LKS 38. And I explained to you what are the important aspects in terms of the LKS 38. Then investment in subsidiaries. This might be important when it comes to the unseen scenario. In consolidation numbers, in group numbers, there's nothing. But in the companion notes, in the separate financial statement of the parent, we have been given the investment in subsidiary figure. So what is the relevant standard for that? Can you tell me what is the relevant standard is? Separate financial statements. LKS. So talking about the separate financial statements. So we are the investment that you make in the subsidiary needs to be measured. You have been given a choice. Remember this, huh? You have been given a choice. Either you can measure the investment in subsidiaries in the separate financial statement of the parent at cost. Most of the time, most of the companies, 99% of the companies are making this choice. But it's not mandatory. In the separate financial statements, investment in subsidiaries can also be measured at fair value. As well as in the separate financial statements, investment in subsidiaries can be equity accounted. But as I mentioned, most of the times it is stated at cost, right? Because why? It is easy if you keep the figure at cost for consolidation purpose. Because, for example, if you fair value based on the consolidation, you have to reverse these value gains. If you have equity accounted, you have to reverse these entries when it comes to consolidation. So because of that, most of the times in the individual accounts of the parent company, investment in subsidiaries are kept at cost. Then other financial assets, IFRS 9 financial instrument standard recognition, measurement, definition are covered in IFRS 9. Again, in the PCE, no specific references to financial instrument standard, but we all know that it's a very important standard, and patients are clearly tested in the exam in terms of the financial instrument. Maybe not in the unseen, but maybe a question from the accounting standards in section A. Okay. Right. So then inventories under the current asset is very simple. LKS2 inventory standard, it has to be measured lower of cost of net realizable value. Here another receivable. Trade receivable is actually a financial asset. IFRS 9. So most of the time, trade receivable is a financial asset, but there can be other receivables that are not financial assets. Example, if you have a prepaid expenditure, you prepaid a certain expenditure, that's not a financial asset. Because to classify as a financial asset, you have to have a contractual right to receive cash from other financial assets. If you have a prepaid expenditure, you don't have a contractual right to receive cash, right? So the most of it under the trade and other receivable can be the financial assets, but there are other assets as well. Amount due from related parties. In consolidation column, there's nothing because payable and the receivable between the parent and the subsidiaries are getting net off in the consolidation level. But if you look at the parent company, there are amount due to parent parties. These are also financial assets. Most of the times, these are also financial assets. The other financial assets covered by the financial instrument standard. Then cash and cash equivalent. Cash is also a financial asset. So the cash and cash equivalents are also financial assets. So you see, a lot of balance sheet items are classified as financial assets. Right, then moving on. Under the equity section, you have stated capital, revaluation reserve, and the retained earnings, right? So thereafter, liabilities, interest bearing loans and borrowings, again financial liabilities. FIS 9 financial instrument standard. The lease liability is coming from FIS 16. As for the leasing standard, you have recognized the right to use the asset as well as the lease liability. And the current portion of that particular lease liability, that is the next year capital repayment in terms of that lease liability, you have to show under the current liabilities. It's coming under the leasing standard, but lease liabilities are also financial liabilities. Okay, then deferred tax liabilities. In a case when bit of a complex standard in a consolidation question, even there can be deferred tax adjustments. So especially when parent acquires the subsidiary, you fair value the subsidiary's net assets. So those value adjustment may result deferred tax impact. Okay. So a lot of examples are there of that nature. And there are employee benefits liability, retirement benefit obligations, as I mentioned earlier. LK is 19, right? Thereafter, trade and other payable. So trade payable is normally a financial liability. FIS 9, but there can be other payable which are not financial liabilities. Examples, let's say if you receive revenue in advance, it's an advance receipt. It's a liability, other payable, but it's not a financial liability because financial liability means that we have a contractual obligation to deliver cash on other financials. Right? There's no such obligation. Right? Then current tax liabilities are also covered under LKS well, income tax standard. In income tax standard, you have current taxes. That is the tax which you have to pay to the Inland Revenue Department based on your taxable profit. And also it covers the topic deferred taxes. What is mostly tested in the exam is the deferred taxes, but you should be aware current taxes are also coming under LKS income tax standard. There are no balances as amount due to the related parties. So if you have any, most of the times these are also financial liabilities. The interest bearing loans and the borrowings, this should be the current portion of the interest bearing loans and the borrowings. This is also a financial liability. Right, so basically, even though I have not specifically discussed this standard, I have focused on the standards where the description was given in the pre. But when you look at the financial position and the profit and loss statement, there can be many other areas where an examiner can, make a question. But as I said, that always sometimes, not always, sometimes examiner doesn't have the discipline to follow the pre-set. He would test you something else. So this something else can be maybe from one of these standards, right? I just wanted to make that note, right? So by looking at the financial statements, what we understand is it's a book. At the moment, parent company has two subsidiaries, 100% of subsidiaries, and in the balance sheet I forgot to mention under the equity section there are no non-controlling interest at the moment. Why don't you have any non-controlling interest at the moment? Because at the moment both subsidiaries parent has 100% ownership. So if the parent has 100% ownership over the subsidiaries, you don't have non-controlling interest. But in the given scenario, I discussed a particular scenario. If parent company acquires 70% over a subsidiary, there can be a non-controlling interest going forward. Right? Okay. Right. So we look at the financial statements. Now, what I wanted to focus is on one of the analysis which was tested regularly in the last two consecutive examination sessions, June 2023 and December 2023, right? So I told you when it comes this paper, you have to look at certain things when you analyze it because your purpose of being a CFO is not just to prepare the financial statements as per the accounting standards and the consolidation rules. You should analyze and use the financial statements to make decisions. Not only that, investors are looking at the financial statements and carry out the analysis to make the decisions, investment decisions. For that, there are different analyses which we have learned already in our previous studies as well, ratio analysis, then common size analysis, trend analysis, a lot of analysis have been done. So when it comes to ratio analysis, one of the important ratio analysis that you can perform is actually input analysis. If you are a shareholder, if you invest your money in a business, what do you really look at? How much of return that you generate, right? Now, let's say if your return on equity by investing in this business is 7%. Is it worthwhile to get this investment? Let's say if I can put this money somewhere else, let's say go and put in a bank, if I can generate more return than investing in this company, there's no value of this investment. You might divest. So to make that decision, one of the key ratios that the shareholders, existing and the potential shareholders are looking at in a company is actually the return on equity ratio. Then, in last two examination session, what examiner has done was, examiner wanted to test component of this return on equity ratio. Actually, return on equity is a composition of three areas. I would say profitability, efficiency, and the leverage. So the first component is what? Profitability. How much of margin that you generate, how much of net margin that you generate. How to calculate the net margin? Your net profit, that is the profit for the year, divided by the revenue, right? So this is actually your NP margin. NP margin, now the question can be, compare the NP margin of the last year with the current year. Then you have to explain the reason for the deviations. When you are explaining the reason for the deviations, obviously you need to look at, let's assume if the NP margin has come down, you have to explain why it is. Possible reasons would be your GP margin has come down. Maybe you reduce the prices of the goods that you sell, or you reduce the price of the services in the situation that you provide, or the certain cost elements under the cost of sales have gone up, or else your volumes have come down. So the GP margin has come down. Or else it would be because of the increase in the expenditure, operating expenditure, like what? Administrative expenditure, selling and distribution cost, advertising cost, right? In addition to your finance cost can go up, your tax expenditure can go up because this is the net profit. After interest, after taxes, what is your margin? Then that is the profitability part. Thereafter, efficiency. Efficiency is looked at by the asset turnover. This is asset turnover. How do we get that? Revenue divided by the total assets. For 1 rupee investment in assets, how much of revenue that you generate? Always better to have a higher asset turnover. Always better to have a higher asset turnover. If you have a higher asset turnover, that means the efficiency of utilizing your assets are better. Yet again, you can calculate this ratio and see that comparing with the last year, what is it? Let's say if this ratio is deteriorated, you have to identify what are the reasons. Reasons could be, let's say you have not managed your working capital properly. Poor working capital management. Your inventories have gone up. Your debtors have gone up. Inventory days have gone up. Debtors collection period has gone up. Unnecessarily tied up money in the working capital. Or else during the current year, you have made certain investment in new projects. You invest in new projects, right? So those projects doesn't generate the revenue for the full year because this investment was at the middle of the year. Now, based on the revenue, the contribution of these new investments into the revenue generation is not for the full year. In the next year, it would be there for the full year. But this particular year, actually, it generates the revenue only part of the year. But when you take the closing total asset value, full asset of this new investment is included in the total asset. Then there's no reason for it to worry that much because you know the reason why it has come down. Right? Then thereafter, that is about the asset turnover, right? Or else are there any idle assets? So there are empty situations where your long-term assets are not generating any revenue. There are certain idle assets, idle lands, idle machinery is there in the business. So that would have a detrimental impact on the asset turnover. Right? Then the third component is the leverage. This is called as equity multiplier. It measures the leverage in your capital structure, how much of debt capital is included. Okay, if this particular ratio is high, that means your leverage is high. If you fund your assets by using debt, this ratio will increase. Okay, so that it actually increasing of this particular equity multiplier has positive impact on return on equity because return on equity has three components: net profit margin, asset turnover, and the equity multiplier. Increasing of all these three areas will cause to have an increase in the return on equity. Now, if you talk about the leverage, yes, increasing in equity multiplier, that means once you add more and more debt into the capital structure, your equity multiplier will increase. That will cause an increase in the return on equity. But remember, your risk is also increasing, right? Because investors, when they make an investment decision, they get the return as well as the risk. If you unnecessarily increase risk to increase your return on equity, that's not something where I should do. Especially tech-based companies, right? Tech-based companies. Return on equity is high. One reason is they are leveraged. So they are taking a risk. Are we clear with that? Are we clear with that? Right. So what it was tested in the last time paper. In the last time paper, what it was tested is actually this particular analysis, viewpoint formula. Look at that question, right? So question number 3, last time paper. There's a full question in terms of the viewpoint analysis. Then in the session, June 2023, in that particular session, viewpoint was tested. In addition to that, breakdown of net profit margin is also tested. This net profit margin can be broken up into 3 more areas. What are these 3 more areas? Anybody aware of it? I would say, first of all, operating profit margin. Because net profit means after adding everything, you will add your interest, you will add your taxes, final net profit of the financial statement. So that is split into operating profit margin. How do you get operating profit margin? Profit before interest and tax. Because interest is related to the capital structure. It's a financing decision. That's not an operating decision. So you remove interest, you remove taxes. What is the profit before deducting interest and taxes? Divide that by revenue. That is your operating profit margin. Then you calculate your interest burden. Interest burden. How do you derive interest burden? How do you get that? Profit before tax divided by profit before interest and tax. What is the difference between the profit before tax and profit before interest and tax? Interest. So interest burden will tell you how much of interest that the entity is incurred. We can compare last year, this year, what is the interest burden? Okay, if this ratio is low, that means what? You pay high interest. Interest burden is high. If this ratio low, that means your profit before tax is significantly lower than profit before interest and tax. Why? You pay more interest. So the interest burden is high. And one more thing, tax burden. Tax burden. How much is the tax burden? PAT divided by PBT. What is the difference between the PAT and PBT taxes? Right? So if this ratio is low, that means you pay higher amount of taxes. If this ratio is low, that means your PAT is significantly lower than PBT. That means you pay higher taxes. Last year, this year, it has gone up. That means your tax burden is high. So when you multiply these three, PBIT divided by revenue operating profit margin into PBT divided by PBIT interest burden into PAT divided by PBT, that is tax burden, what do you get? You get the NP margin. So in, as I mentioned, June 2023 paper, this was also tested. And the DuPont part was tested in June 2023 as well as December 2023 papers. So because of that, this is an important aspect. So because of that, what you do is get the set of financial statements. I'm not going to calculate it here. You can do the computation by yourself. Apply these ratios and do the computations. More importantly, be ready with the interpretation. Why it has happened? If the net profit margin is declined, why it has happened? If the asset turnover has declined, why it has happened? If the leverage increased, why it has happened? And what are the implications of this? Be ready to answer. Hope you are clear with that. So that is, now we analyze the set of financial statements. And also we looked at the DuPont analysis that we can do by looking at the financial statement numbers. I have worked out the numbers. You can easily do it because you have the formulas. Please do that by your own. And there are two more things which I need to discuss. SIC 32. We learned about LKASs, SLFRSs. We know the accounting standards. But remember, in your SL1 syllabus, ABR syllabus, there are certain IFRICs and SICs also applicable. These things have not been tested for a long period of time. That's true. But what I'm telling is, as this particular reason about a tech-based company or a platform-based business, a mobile app, right? There can be a possibility because the website, there should be a website for this particular company, right? Because that's a e-business. You should have a website in your business. So we discussed about the intangible asset standard, which is LKS 38, and what are the important aspects in terms of this pre-scene we discussed. But there's a particular area in this intangible asset standard, it specifically doesn't discuss about the accounting for the website. Website is also an intangible asset. But the standard doesn't talk about specifically about accounting for the cost that you incur in terms of the website development and the website maintenance. So because of that, what IASP has done was they have issued a interpretation. This interpretation is actually SIC or SIC 32. Okay, so with regard to the intangible assets and specifically focused on the cost that you incur in terms of the website development. So I believe that having an understanding of this is important for your examination because that can be tested. If it is tested, you should know about how I'm going to do the correct account. Right? Okay. Before moving forward, shall we take, as we are listening, continuously. Shall we take not a big break, 5 minutes break, because to complete this, plus more importantly, I also want to complete financial statements of a tech-based company that I have taken from a article, right? So what are the specific features of the financial statement of tech companies, P&L and balance sheet? So these are two areas we have to complete actually, 632 intangible asset website and the financial statements of tech companies. So let's take 5 minutes break. After 5 minutes break, we can complete these two areas. Right, hope you are back. Okay, before moving forward, let me clarify a few doubts what you had. So, one question was actually, if I go back, one question was the third scenario, what I have explained in terms of the consolidation. If there's a new parent company, new investor, with acquiring 35% of the public holding maximum, where two brothers are holding their shares they are going to sell. So in that case, the question was having 35%, whether the parent and the subsidiary relationship is established. So what is important is the control to be established. To establish the control, yes, shareholding percentage is important, but that is not the only criteria which will give you the control. What can happen is in this scenario, so the new investor is having 35% of Quick Key PLC, but you enter into a shareholder agreement, new investor and the two brothers, and through the shareholder agreement, control is given to the new investor, new parent company, right? So in that case, even though the new parent company is having maximum 35% of the ownership of Quick Key PLC, as the control is given through the shareholder agreement, new company or the new investor can consolidate Quick Key PLC plus the two subsidiaries what it has. Okay, likewise, there are number of criteria that you have to evaluate when whether the control relationship is established or not. So that is discussed in the consolidation related area. You need to prefer those indicators where sometimes you might not have the majority ownership of investee, but still you have the control over the investee, right? That I have answered. Then there's another question in terms of the scenario 2, which I have mentioned about the consolidation. If we apply the related party transaction standard, which is LKS 24 to the scenario, whether now in case if POS would become a joint venture, where there are two joint venturers, Quick PLC and the other investor, that is the lead chef. The question is whether Quick PLC and this other chef are related parties. No, we looked at, right? If you have a joint venture, that joint venture, in this case, POS and the joint venture investor, QVP, Quick PLC and the POS are related parties. Joint venture investor and the joint venture are related parties. But two venturers, two investors, Quick PLC holds 50% and the other investor holds 50%. Quick PLC and the other investor are not related parties, which I have explained when I was explaining LKS 24. Hope it is clear, right? Then some of you have questions about, okay, the numbers, what is getting appeared in the financial statements now here, group figures, investment property value gain, current year 30, last year 20. Company also 30 and 20. Is that possible? Yes. Let's say only the parent company is having investment properties. So in that case, subsidiaries are not having any investment properties. So in that case, what is there in the company column is the same figure what is getting appear in the consolidation column. That can happen, right? That can happen, right? So those were the questions raised up until now. I answer to those. Okay, so when you are preparing the consolidated financial statements, now let's say, again, the question might be, let's say if scenario 1 happened in consolidation, when you prepare the consolidated financial statements, as I mentioned, you have to prepare from the perspective of Quick Eat PLC. There are two subsidiaries and there will be an addition of a subsidiary. So for the purpose of preparing the consolidated financial statements, practically what we do is we do the line by line addition, right? Parents figures and two subsidiary figures, actually now there are 3 subsidiary numbers. Now if you do the line by line addition, no? You do the line by line addition for the parent plus 3 subsidiaries. That's what you do. But sometimes, depending on the information given in the case study, now in this case study, you have not been given the financial statements of Quick Eat IT and Quick Eat Riders. So you have been given only the company financial statements and the consolidated financial statements of Quick Eat peers. And if this new subsidiary is added, if you are asked to prepare the consolidated financial statements, then you have to do it based on the given information. So the given information in the sense, now you have already prepared the consolidated financial statements, including the parent plus the 2 existing subsidiaries. So you have to add the figures and do the relevant consolidation workings for the 3rd subsidiary. Okay. So depending on the available information, you have to do it in the examination scenario. Hope you are clear with that. Right. Okay. Now let's move to the analysis and the interpretation part. So we need to look at one of the interpretation made by IASB 632, intangible asset website cost. Right. So this particular company should have a website, right? So it's an intangible asset. But as mentioned in LKS 38, there are no specific guidance on how to account for the intangible assets relating to the website development. So because of that, this new interpretation, this particular interpretation was issued. So you should understand, first of all, what is the scope of this interpretation? What is the scope of this interpretation? Scope in the sense, as mentioned, it covers the accounting for the websites, but it does not cover these 3 areas. These 3 areas are out of the scope. What is 3 areas are out of the scope? Running expenditure of a website. Like any other asset, you have to maintain the website. Okay, each month you have to incur certain expenditure. These are running costs of the website for the regular maintenance work. So accounting for that is not covered here because regular running expenditure are getting charged to the P&L, right? Then with the website, you need certain hardware assets like servers, internet connections, computers. So this particular interpretation, 632, doesn't talk about how to account for the hardware assets because why? Accounting for the hardware assets actually covered by what? LK 16, that is PP&E, property, plant and equipment. Apply that standard. That is also scoped out from this particular interpretation. Expenditure on development of a website for sale in the ordinary course of business. You are developing a website to sell in the ordinary course of business. Here, your intention is not to use it, but for sale. So why it is not covered in this interpretation? Because this is covered by LKAS2 inventory standard. If you produce something for the sale in the ordinary course of business, it's inventory. Irrespective of what the asset is, even though it's a website, your intention is to sell and make profit. Sale in the ordinary course of business. You have to apply LKS2. That means initially measured at cost, subsequently cost on a realizable value, whichever is low. So these 3 are out of the scope of this interpretation 632. Then to capitalize the cost in terms of the website development, what you need to do is you need to look at the recognition criteria. If all these recognition criteria are satisfied, then you can capitalize the cost incurred in the website development. When you look at these recognition criteria, these recognition criteria are actually similar. 6 recognition criteria, what I discussed in terms of the internally generated intangible asset during the development phase. If I go back there quickly, let me go back there. We discussed at the very beginning here. intangible assets, which are internally generated, development stage, you can capitalize the cost subject to the satisfaction of 6 recognition criteria, right? So the 6 criteria, what is mentioned in 632, are almost similar to the 6 recognition criteria, what is applicable for the development stage internally generated intangible assets. So that you don't have any issue of remembering these 6 recognition criteria, what is mentioned in 632, right? Let me go there now. Right. First of all, for you to capitalize the cost incurred of the website, you should have an intention to complete the website and use it. If you don't have intention, you won't complete it. Don't capitalize the cost. Then you have ability to do that. You have to have, so intention is not enough. You are able to do that. If you are not able to do that, again, don't capitalize the cost. Then you should have the technical feasibility. The technology should be there with you. Technical feasibility should be there with you to carry out the development and complete the website. Then resources, adequate resources should be there with you to complete the development of the website. Then the 2 general recognition criteria. Future economic benefits are probable and cost can be measured reliably. These are the 6 criteria that you have to satisfy to capitalize the cost in terms of the website development. Here, this particular criteria is given a prominence because in the case of the prominence in the sense, in exam point of view, the questions can be asked from this particular point. Why? Because if you look at the websites that you know, which are developed by companies, those websites are developed for multiple reasons. There can be internal purposes, like what? To carry out your day-to-day operation, you need to have a website. It facilitates your day-to-day operation, right? Or else you need to store your data somewhere, so you keep that data in the website. Those are internal needs, right? If you use a website for the internal purpose, can you say that there are probable inflow of economic benefits? You can't. So in that case, if you develop websites for the internal purpose, you can't capitalize because this particular criteria of probable inflow of economic benefits are not satisfied. So because of that, you need to charge that to the P&L. On the other hand, there can be external purpose of a website. When it comes to external purpose, there are a number of external purposes. One purpose would be to advertise your products and the services, so that you are advertising your products and the services through the website. Can you capitalize that cost? In that particular scenario, the website development cost, what do you say? You can't. Because why? Are you generating a economic benefit out of that? Just advertising, mere advertising? You can't generate any economic benefits. I told you advertising and promotional expenditure needs to be expensed to the P&L. So yet again, if you are purely using a website for the advertising and the promotional activities of your business, you can't capitalize that cost. Also, you need to charge the P&L. But let's say you develop a website, you use that website to take the orders from your customers, online orders. You take the online orders and supply goods and the services for these orders and generate revenue, money out of it. Then the cost what you incur in the website development, you can capitalize. Right? Then only this particular criteria of probable inflow of economic benefits are satisfied. So for you to prove that, the activity for which you generate or develop the website capable of generating the revenue. Example, online orders. But if it is purely for the purpose of advertising and promotion, you can't capitalize the cost of developing the website. Is that clear? This is no. Then let me ask a question. Let's say you use the website for both purposes. You are advertising and promoting your products and services, as well as you are generating a revenue out of it through taking customer online orders. Then what do you do? Can capitalize or not? Then you can capitalize. If you generate revenue, that's enough. Then the website can be used for the revenue generation as well as for advertising and promotion. Then the full cost you can capitalize. Are we clear? I hope you understand about it. Then when it comes to initial measurement is at cost. Even intangible assets are initially measured at cost. This initial measurement should include only the directly attributable cost to bring the website into the operating capability which is intended by the management. So creating, producing, and preparing the website to be capable for operating in the manner intended by the management. So what you can capitalize is only the directly attributable. You can't allocate your overheads into that, right? Directly attributable cost. So this is similar to the initial measurement at cost in many of the other standards. Even there, you can capitalize only the directly attributable. Right. So this particular slide, so there are a couple of slides like this are really important. That is, when it comes to website development, there can be number of stages. You should be aware on what is the accounting treatment in each of these stages. So the first stage in a website is the planning stage. What do you mean by planning stage? What do you do actually? You do the feasibility studies, whether it is feasible or not. You develop the specification for the hardwares and the softwares. Then you evaluate alternative products, alternative suppliers. You do the planning part. Tell me, if you incur any cost during this stage, can you capitalize? Your general common sense. Can or can't? You can't. Because why? This is something similar to the research phase, right? Of an internally generated intangible asset. That's why I said that. So most of the stuff in this particular interpretation is similar to the LKS 38, intangible asset standard. So whatever the cost that you incur during the planning stage, which is almost similar to the research phase of internally generated intangible assets, are expense to the P&L. Then we move to the second stage. What is the second stage? Application and infrastructure development. In this particular stage, you might acquire certain hardware items as well, like what? Web servers, internet connections, computer. That is important for the application and the infrastructure development. But we learned at the very beginning, hardware items are not covered by this interpretation. It is covered by what? LKA 16, property, plant and equipment. So those are property, plant and equipment. So apply LKS 16. Don't apply this interpretation for that. These are not intangible assets. They are property, plant and equipment. Apply LKS 16. I'm not going to explain that. You know that. Then during this phase, you may also carry out the activities like obtaining a domain name. In any website, you need to have a domain name. Then you have to actually develop your software. Then you have to install the software. So what do you say? So the cost incurred on those activities, can you capitalize or you can't? You can capitalize because why? At the end of the planning stage, you know that outcome is certain. At the planning stage, outcome was not certain. That's why you expense the cost. But now the outcome is certain. So the expenditure that you incur on domain name, developing and installing software, you can capitalize provided recognition criteria are met. What does that mean? Let's say if you incur the expenditure for domain name, installing software, developing software for a website which is used for the advertising and promotional expenditure, or which is used for the advertising and promotional purpose. In that case, can you capitalize this cost? No, because why? Even though it is in the application and infrastructure development stage, if you develop this particular website, if you develop this website for merely advertising and promotional purpose, you can't capitalize the cost. So that's why it's mentioned you can capitalize the cost subject to the meeting of the recognition criteria. That means if this website is used to generate revenue to take online orders, then you can capitalize this. There's no issue on. Right? Clear? I hope you understood what. Right. Then graphic design. This is actually the appearance of the website. Like you need to decide the colors, you need to decide the layout of the website. Right? These are critical features. So yet again, you can capitalize the cost, capitalize, but provided the recognition criteria are met. Same rule. You should meet these 6 recognition criteria. Subject to that, you can capitalize the cost, which means yet again, if you develop the website for the advertising and promotional purpose, then even the graphic, that the cost incurred in the graphic design stage, you can't capitalize. Because why? It doesn't meet the recognition criteria. I hope you understood. Then the content development, where you create the links to access for the users to the website. Then update the text, graphics in the website. You develop the content, you decide the content, and you create the links. Yet again, this is something important, necessary. So you can capitalize the cost provided recognition criteria. Now you know what we mean by provided recognition criteria. So all 6 recognition criteria should always met for you to capitalize. Otherwise, you can't capitalize in whatever the stage it is. Right. Then finally, operating stage. Now it is in operation. When you carry out the operating stage, I will start from the second one. If you incur maintenance expenditure, including hosting charges, now website has to be maintained like any other asset. There are recurring expenditure to be incurred. Those operating expenditure like maintenance cost, hosting charges, those costs you can't capitalize, those has to be charged to the P&L. Because like any other asset, there are maintenance work to be carried out, even in a website. So those costs you can't capitalize. There's no value addition, you need to charge to the P&L, but those activities are important to operate the website. Then if you look at the last one, I told you what you can capitalize is the directly attributable cost in terms of the development and creation of the website. Things like administration, other overheads, then training employees to use the website, initial operating losses. These items can be capitalized in the website cost. Those has to be charged the profit and loss. Simple. But even in the operating stage, if you upgrade the website, if you update the graphics, if you update the content, if you add new features, if you add new content, so those are value additions that will generate additional economic benefits. So if you can prove that you can generate the additional economic benefits through these upgrades and the updates that you do, those costs can be capitalized yet again, subject to the 6 recognition criteria what I have mentioned. Are you clear? What are the stages? Planning stage, application and infrastructure development stage, graphic or the graphical design stage, content development, and the operating stage. And what are the costs that you incur and what is the accounting treatment? Clear. Then this is also similar to the thing what we have learned in terms of the internally generated intangible asset. What I want to tell you is, let's say there are certain costs what you expense to the P&L in the planning stage. Because why? At the planning stage, you are not aware or you are not certain about the outcome. Whether it is successful or not, you don't know. Let's say last year you expense these costs to the P&L. But now, let's say once you move to the next stages, we know that our effort was successful. My experiment, my planning work is successful. Now we know that. My question is, can I go back and capitalize the cost which I have originally charged to the P&L? Is it allowed? Not allowed. You can't do that. If you charge to the P&L, that's it. Later on or subsequently, you can't capitalize that. So that is similar to the what? Cost incurred in the research stage. I told you, if you charge the research cost to the P&L, in a subsequent period, you can't capitalize that research cost. Website development expenditure recognized as an expense in the profit and loss statement cannot subsequently reinstated as an asset. Okay, right. Then the subsequent measurement is also exactly similar to the subsequent measurement rules, what we learned in LKS 38, intangible asset standard. So you can subsequently measure either at cost or the revaluation model. Cost means cost minus amortization minus the impairment losses, if any. Revaluation model means you revalue the intangible asset or the particular website, and that revalued amount you amortize, and if you have any impairment losses, you recognize. But similar to the LKS 38 intangible asset standard, here also, if you need to use the revaluation model, you have to prove that for this particular website, there's an active market. If you don't have an active market, you can't use the revaluation model. We know that most of the websites, for most of the websites, there's no active market. So because of that, even though in books, there's a subsequent measurement model for revaluation model for the websites, most of the times, I think almost all these websites are measured at cost, because why? There is no active market, because those are unique most of the times. But if you are given a scenario in the exam to say that in the unseen, to say that this particular website is having an active market, then fine. Then you can either use the cost model or revaluation model. Right. So that particular section is also done. That is about 632 website development cost. Right. Then the final area of the analysis and interpretation which I need to take is actually these are general stuff I have taken from few other resources. Right. So what are the features of financial statement of tech companies? What are the highlighting features comparing with the other businesses that you find out in the statement of financial position and the profit and loss statement of a tech company? In Sri Lankan context, sometimes these things might not be valid, because one of the thing is actually in tech companies, normally your market capitalization is higher than the net asset value. Market capitalization is huge comparing with the net asset value. Companies like, think about Facebook, Google, Amazon, Uber, right? But in our context, most of the times, in most of the companies are listed, market capitalization is less than the net asset value. Right? Even the company that have been given in the case study, have seen they have given the share price as 32 rupees per share. So the market capitalization calculated market value of the share into the number of shares. No? So the market value of the share is 32 rupees. But the net asset value per share is something close to 38. So which means our market capitalization in the particular company that you have been given is less than the net asset value. But it is not the case in developed markets, because we all know Sri Lankan market, Sri Lankan share market have been clashed. Okay, a couple of years back. So the price have been drastically declined. So because of that, most of the companies actually market capitalization is less than the net asset value. Right. But generally, when it comes to the developed countries, it is other way around. If it's a tech-based company, your market capitalization is huge comparing with the net asset value. So according to the conceptual framework, what we say is statement of financial position of the company provides relevant information about the financial performance of that entity, liquidity, solvency, gearing. You provide the relevant information. Similarly, profit and loss statement provides information about the performance of the company. But what I want to tell you is, when you prepare the financial statements by applying the accounting standard for a tech-based company like Google, Facebook, Apple, Amazon, Uber, sometimes the statement of financial position and the statement of profit and loss does not reflect the true financial position and performance. Why is that? What is the reason? You can go through, I'll explain the highlighting features. First of all, when you look at the statement of financial position of a tech company, tech-based company, now take the example of Uber, right, or Facebook. They have very powerful and valuable brands. These brands are worth in billions. But we know that as per the accounting standard, LKS 38 or international version is IAS 38. So you can't recognize internally generated intangible assets, including internally generated brands in the financial statements. So because of that, these powerful brands which are owned by the tech companies are not reflected in the statement of financial position. So that is one reason where, as I mentioned earlier, market capitalization is huge comparing with the net asset. Because the market value reflects these powerful or valuable brands, but not the net asset value. Right? That is one feature of a statement of financial position of a tech company. Another important aspect is these tech companies are using assets which are not owned by the company or even not leased by the company. Think about Uber. So they use other people's vehicles, and the carriers or the drivers are not employed in the company. Two things: these motorbikes or whatever the delivery vehicles used by the drivers are not owned by the company, not leased into the company. They use these assets in their business model, but they are not in the books. Correct? Then there are people who are working for the company, not in the payroll of the company. In this case, in the case study, in the pre-scene, there are independent contractors who are working for the company. They are using their own bikes or the vehicles for the revenue generation of the company, but still, it is not in the statement of financial position. Agree? Right. Then the other thing, let's say there are intangible assets which are recognized in the statement of financial position. Now, in this particular pre-scene, you have been given the mobile app. And let's say that particular mobile app is recognized on the statement of financial position. And so certain intangible assets are recognized on the statement of financial position. Now, after you recognize these intangible assets in the statement of financial position, as per the accounting standards, what we need to do? We have to amortize them, right? And we looked at most of the times subsequent measurement has to be at cost. Because why? There is no active market for you to use the revaluation model. So that you have to follow the cost model. Cost model means what? You take the initial cost, then you amortize over the period of time. So the value of the asset is getting reduced in the books. But actually what is happening? Value of these intangible assets are increasing over the period of time. When the new users are added, now let's say for our mobile platform, once the new restaurants are added, once the new drivers are added, actually the value of these intangible assets are appreciating, the market value. But in accounting terms, what will happen? This has to be amortized, so the value of the assets are declined. Okay. But actually, the value is appreciating with the addition of the new users, because once a new user is added into the platform, what you need to do actually? Worst case, you need to increase the server capacity. Okay. Then you have certain amount of negligible operational cost to support that particular user, to help that particular user regulate his activities, online activities. You have to incur certain operation cost. But the benefit is huge, right? Because adding of the new users into the platform is a benefit to the other users, as well as you can earn more and more money by advertising in the platform. Because having a higher user base means you can encourage other people to advertise the products in your platform, and you can make money when the new users are added, when you have more and more users. But that benefit is not reflected in the financial statements when you follow the accounting standards. Right? That is about the statement of financial position of a tech-based company. What about the profit and loss statement? Profit and loss statement. Another important observation about the tech-based companies in the global context is Sometimes companies are making operating losses, or else companies are making small amount of profit, but market capitalization is huge. Why? Because if you look at a text-based company, matching concept won't work. What do you mean by matching concept? Basic concept. Your revenue, you have recognized the revenue. Once you recognize the revenue, related cost also to be recognized. But think about a tech-based company. Yet again, the examples that I have given: Google, Facebook, Amazon, Google. So they are initially you have to incur huge capital expenditure to set up the company. Then in the initial years, you have a huge amount of depreciation because these capital expenditure, what you capitalize, are getting depreciated. So you are making losses in the first few years. That is the typical nature of a P&L of a tech-based company. But after a particular point in time, once you incur all these costs, let's say you fully depreciate your assets. But what will happen thereafter? You will be generating massive profits. Let's say a tech-based company is continuously making losses. And in the particular year, let's say in the current year, you make a huge profit. In that year, share price will increase drastically. Why? People know that in the life cycle of the business, it has moved to a different stage now. Earlier, it was in the high risk, capital demanding initial stage. Now you make money in this year, you make profit in this year, means now you are moving into the mature, less risky, cash generating stage. So you need to understand the life cycle of the particular business, especially when it is a tech-based company. When you analyze in the P&L, it doesn't mean that P&L is not important. Revenue figures are not important, because revenue figure is important for you to look at the growth, for you to understand the market share. That is important. But what I'm telling is the matching concept doesn't really work here. So initial stage losses or small amount of profit, thereafter you can make huge amount of money. So here again, you can read it, right? So the explanation what I have given over there, or what I have given is over there in this slide, you can read it. So then what are the remedies? Now let's say when you analyze, you know that these problems are there in the statement of financial position and the statement of profit and loss of a tech-based company. What are the remedies where you can suggest when analyzing the financial statements? Because in the last time paper, in the unseen, examiner wanted the students to recommend what are the performance measures that the company should use. Initially, it was about ROE, as I mentioned, DuPont analysis. Then, in addition to ROE, what are the other aspects of the business that you need to look at? Right? It's not purely numbers, financial analysis. There can be questions in that particular nature. So this is where non-financial reporting would come into play. So if you apply integrated reporting, because in the traditional financial accounting, you just look at the financial capital. But in integrated reporting, you look at 6 types of capital: social and relationship capital, human capital, intellectual capital, natural capital, financial capital, manufactured capital. So how do you remember these 6 areas? Anybody, if you forget these 6 types of capital, remember this word. Team FM. Team FM. Social and relationship capital, human capital, intellectual capital, natural capital, financial capital, then manufactured capital. So in traditional financial accounting, you look at only the financial. But in the integrated reporting, you discuss about the value creation. Right? What are the inputs? What is the business model? What is the entire value creation process? The other thing is other non-financial performance measures. You can have key performance measures which are not financial. Example, online real-time reporting of key performance indicators like what? How many members are there in the website? How many members are there in the platform? You don't need to wait until year end to do that, right? You can do it then and there on real time basis. You can give a indication. Okay, these are the new members or users added during the day. With that, what is the total? Whether it is increasing or declining. Okay? Then how much of cost that you incur per user? Because once the number of users are getting increased, I told you your cost increase is negligible. Because why? You once new members are added to the platform in this particular scenario, once the new restaurants and the drivers are added to the platform, the amount what you need to spend is negligible. You have to incur certain recurring costs to support and help them, these new members, as well as to regulate their activities. And you might need to increase the server space, but per user cost has to come down over the period of time. So you can measure these things. You can suggest these things. Not only the financial performance, look at other aspects of reporting like integrated report. So there are 6 types of capital. Then look at other key performance indicators like membership numbers and the per user cost. And you don't need to wait until the year end or quarter end or month end. You can do it on real time basis then and there. Right? These are remedies. Right. So any questions that you have raised? Okay, so there's a question whether we can keep the website as an intangible asset which has indefinite use. Highly unlikely, because it is if you need to make it to a intangible asset which has indefinite useful life, a thing like website, you can't prove that. It's not easy, right? So because of that, normally what you do is you have to amortize that over a period of time. Okay, so there are questions related to the governance where you need to watch the video in terms of the governance, risk, and the audit aspect. Not audit, right? There's no audit now. Risk, governance, and ethics. So that was already done by Suranga. So the recorded video is also available. So please clarify that with the particular lecturer. Okay, so there's a question why the incorporated companies do not recognize the goodwill on the financial statements, because when it comes to the company, if you incorporate a company, net asset value of the subsidiary is equal to the investment made by the parent, because net asset value or the share capital of the subsidiary is the amount that the parent invests in the subsidiary company. So once your investment and the investment of the parent books and the share capital of the subsidiary books are similar or same, there's no goodwill figure. So there's a question whether there can be a disposal scenario of existing subsidiary. So as I said that with regard to the, if examiner maintain the discipline, where if we want to really link the pre-seen and unseen, it would be an acquisition related question. But I told you there are several examination sessions where he has given something new in the unseen. So because of that, I can't say it's not possible. You need to be thorough with all areas of consolidation. Don't take a chance. If it is a disposal question, just handle it from the knowledge what you have it. Okay. Suddenly you can say that, okay, maybe the riders, quick hit riders, there's no use of having the company, we won't dispose. And information can be given. Yes, possible. But as I said, I have, because I can't give 10 scenarios to you, right? Then you'll be end up with nowhere. So what are the possible scenarios based on the present information? But it doesn't mean that examiner can't test the other areas. He might test. Then use your data or basically the knowledge what you have gathered through the studies. Yeah, so the PowerPoint presentation I will share with Sri Lanka, so they will share with you. I think there's a question, customized web-based course. So I have explained, right? There are different stages. What we need to do in terms of the stage, I have explained. Okay, so example was given where a particular company is considering the website as an indefinite life asset. Yes, you can prove that it has indefinite useful life, possible. But normally, the website doesn't have indefinite useful life. Okay, question whether there can be a foreign subsidiary. Again, the same answer. So if examiner suddenly give a scenario, yeah, actually that is possible rather than a disposal, that is possible, right? Because they are anyway looking at acquisitions. And this particular case study or the pre-scene is not complex as well. So, that's a good question actually, right? There is a possibility of acquiring a foreign subsidiary as well. It's an acquisition, but not a local subsidiary that can be a foreign subsidiary. What is not given because we have been given details about two target companies in the pre-scene. So in the unseen, examiner might say that actually Quick PLC decide to acquire a foreign subsidiary, foreign company, rather than these two companies what we are talking about. Or you acquire one company, let's say you enter into a joint venture, and the other company, it can be a foreign subsidiary. So if you have the scenario of acquiring a company and where you are asked to prepare the consolidated financial statements, including the two existing companies and the third company, what you can do is you can use the already prepared consolidated financial statements of the three companies in the group, parent plus two companies. Then you add the new company. And there were actually past few questions in that nature. But as I said, practically, theoretically, what do? You do the line by line addition of all four companies, parent plus two existing subsidiaries and the new subsidiary. But it all depends on what information available in the exam. If you are not being given the individual accounts of all four companies, you have to find out you have to find a way out depending on the information given in the exam scenario. So the forecast have been given. Actually, that is relevant with the SL2 mainly, right? Financial management aspect, not relevant that much to SL1. Right. So I answered to the questions what you raised. And if you have any other questions, you can raise. Otherwise, we'll make a conclusion for the session. Thank you very much for being there. Almost 4 hours spent. It's a detailed analysis of the freezing. Right. Hope the session was helpful for you all. And ensure that you focus on these areas. But it doesn't mean that you don't need to look at the other areas because in the balance sheet, I explained to you, there are so many accounting standards which are relevant to the balance sheet and the P&L items. So, but focus on the pre-scene areas we have mentioned, and look at the other areas as well. So, if you have any further questions, you can raise the questions, or else we can make a conclusion. Hope it was helpful, and I wish you all the best to complete the examination right in this session, June 2024, and soon become chartered accountants. So the Surangasa's recorded video is available in the CS Sri Lanka YouTube channel. You can watch that. So he is covering the governance, risk and ethics part. So it's available. So if any of you missed the session, or else if your friends wants to watch it, so CS Sri Lanka will upload this session also in their YouTube channel. You can watch it again, or else so this also can watch it later. So the recorded version will be uploaded by CS Sri Lanka within the next couple of days. Right. With that note, we'll wind up. Okay. The presentation slides. I will share these presentation slides with CS Sri Lanka, so they will email it to you, or they will share it with you. If not, please contact institute. Right. You can get it from there. So CS Sri Lanka will share it, right? So the presentation they will let me share. Right. So that's it then. Good night to you.